Equity. And there we are. Hopefully you guys can see me. Hopefully you guys can hear me. Got some things planned for you today. We've got some two AI trends of 2026. And here's the interesting thing is that these trends became apparent this past week where we saw two acquisitions. There was one acquisition as it related to NVIDIA, and there was one acquisition as it related to Meta platforms. And it's interesting that these two acquisitions happened right at the tail end of 2025, because I really think these two acquisitions will set the stage for 2026. One of the acquisitions was on the chip layer. So at the semiconductor layer, NVIDIA made an acquisition. I'm sure most of you saw this. This was Grok. And then there was a software application layer acquisition. This was Meta buying a company called Manus. Impacts OpenAI a little bit, and we'll discuss a lot of that on today's show. And I believe this is going to be one of the trends that a lot of investors start to talk about as we move in to later in 2026. I also have a very special guest as well coming up in about 20 to 30 minutes. We're going to have Quality Invest here on YouTube. Aria, not only on YouTube, but also on Twitter or X or whatever you want to call it as well. And so he will join me probably about 20 or 30 minutes, and we'll be discussing all things as it relates to some of the stocks that he's interested in. I know that he's been bullish on this company, Zeta, Z-E-T-A. I don't really know much about it, so I'd like to hear about that. He is bullish on Uber. So we'll have a spirited discussion on that, and also Adobe as well. And so we'll discuss those stocks and maybe others as well. That'll come up in about 20 to 30 minutes. But I do want to start things with this two trends that I am seeing in the new year. And it's going to come at the chip layer and at the software layer. And again, it has to do with the acquisitions that were made this week, but this was a trend that has been bubbling all year. And I believe we're finally seeing kind of the tipping point from it. Now, you might say, well, Colin, this is kind of a weird segue. The fact that you are going from talking about AI and technology to silver and gold spiking. Now, that happens to be a good thing. Well, I wrote something up on Substack this week. If you have a chance to subscribe to my Substack, I think I have like a hot link URL that is kind of rolling down on the bottom. But I'm trying to actually make the Substack as good as a lot of the paid stuff over on Substack. And this is a free newsletter. And what I think, like most of you, I've been out there and I've been seeing gold spike. I've been seeing silver has been absolutely, I mean, this has gone absolutely parabolic. This is GLD, which is the proxy ETF, if you will, for gold. It broke out of kind of a channel, did a back test, and I mean, it's blast off. Like, we haven't seen this type of blast off move in a while. Silver also making this blast off move that you see every couple of years, but what you often see with the precious metals is that they have these moments where they catch investors' interest. And so what I did was I was like, well, I know this has happened before. I know gold has blasted off. And look, if you have gold coins or silver coins or whatever it happens to be, you're happy. Things are good, right? Okay. But I want to know what happens next. So silver and gold have blasted off in the past, particularly in the 1980s, where you had President Nixon remove the United States from the gold standard. And I promise you this ties into technology here in a moment. You had, after that followed a massive move down. So you had the United States removed off the gold standard. You had inflation. You had Paul Volcker come in, raise interest rates. You had, rapid inflation. You had gas lines. You had oil embargoes, all this stuff going on in the United States. And then gold crashed. In 2 years, less than 2 years, it crashed 57%. Interestingly enough, the personal computer was invented right around that time, and IBM stock basically went up for 2 or 3 years in a row. In fact, it went up 144% from June of 82, which is about a year after they released the first personal computer, to October of 1983. So like, what's that, like little over a year? It went up 144% and actually kept going up. Okay, so that was the first time gold had a spike. Everybody was saying gold's, gold's everything. Gold you should be investing in, physical assets, all that type of stuff. What ended up happening was gold crashed and technology stocks started soaring. Now, in September of 2011, those of you that are my age, maybe a little younger, you probably remember 2011. This was on the heels of the great financial crisis, which began in 2008 and bottomed sometime in 2009. And so fast forward to 2011, and the stock market had recovered a little bit, but it was still down about 15% from its all-time highs, or one of its peaks back in 2007. Hadn't fully recovered that. And the crisis was just beginning across Europe. The United States government even got its credit rating downgraded. This caused gold to continue to spike. In fact, it went up quite a bit during the great financial crisis. However, it peaked in 2011. And what did that do? It basically signaled one of the greatest tech trades of all time. Amazon, Microsoft, Google, and Apple went from a combined $716 billion worth of market cap to over $4 trillion. So I thought that was interesting. The two other times that we've seen gold and silver, both gold and silver, spike and go parabolic, and people kind of rush into that. Shortly after that, tech stocks, back in the 80s, it was personal computers, it was Microsoft, a little bit of Apple. They had one of their biggest runs of all time. And then again in 2011, on the heels of the great financial crisis, tech stocks went on a parabolic rally. And so here we are, where silver and gold have gone parabolic. And yeah, if you were like me, I'm sure many of you, I was buying silver coins when it was $15 an ounce. I bought a couple of gold coins when it was like $1,800 an ounce. So I feel okay about that investment. But what happens next? I believe we're on the precipice of an absolute outperformance by the tech sector. I know that sounds insane because it's outperformed for the past decade, but I think we're on the heels of again, because one sector always outperforms after a gold and silver spike, and that was technology. And this was across the board. And here's some of the reasons why, right? Technology solves a lot of problems. And if we look across the stock market, there are stocks out there that are having problems. Chipotle is one of them. Okay, I have some Chipotle stock. Wages are really high. We'll talk about tariffs here in a second. So goods inflation and those types of things. Their consumer tends to be a little bit younger, so they don't have as much disposable income as, say, maybe like a cruise ship stock that is catering to retirees and those types of things, or Home Depot. Wages are still really high, and so that's hurting Chipotle from a labor standpoint, and their stock is down 56%, just really over the past year and a half or so. You also have tariffs that are still a thing. Now, it doesn't impact necessarily most of the technology stocks, or some of them, but tariffs are a thing. And Nike, when they had a conference call a week or two ago, we're still talking about tariffs, and it's still a big deal. And we have a Supreme Court, I think, ruling on the tariffs coming probably within a matter of weeks. And so we'll see what happens there. Even if they get reversed and there's, quote, refunds, my guess is the president will find a new way to implement whatever tariffs that he wants to have. Well, that's killed Nike. Nike's down 68%. And so when we look across the landscape, yes, there's some companies that are doing really well. Yes, the stock market's at, basically a record and those types of things. And that is what's different this time compared to previous times where gold has spiked. The market wasn't set up at all-time highs. So something to think about. But what is the same is that businesses need to cut costs. If you're Chipotle or Starbucks or Target or Nike, they need to do more with less. That certainly applies to all of those. And you also need to innovate. You have stocks, which we'll talk about with Aria here in a little bit. We'll talk about a stock like Adobe. I think he's also looking at a company called Trade Desk, which is like a kind of an advertising platform, if you will. You have Novo Nordisk, which has seen its shares just absolutely get blasted. I mean, this company created a straight miracle drug, and it's basically been downhill since then because of the pricing of the drug and on those types of things, competition, and right sizing your business after a massive kind of hit drug comes into the market. A lot of companies, from healthcare to finance to technology to obviously mainline retail and brands and restaurants and food, they need to innovate as well. PayPal, financial stocks as well, they need to innovate. And I think that's what we're seeing. And so how are companies going to innovate? They're not going to go and do it with bars of gold, right? And so I think this really underscores what is about to happen, not just in 2026, but I think going forward as well for the next couple of years, is that yes, investors are piling into the precious metal trade. Yes, it's worked. Yes, a portion of your portfolio should have already been allocated here. Now I'd wait for a little bit of a pullback. I don't think there's any reason to necessarily pile in at these elevated levels with the precious metals. But many companies are their stocks are not at all-time highs. In fact, they're at 3-year, 4-year, 5 years. Nike stock hasn't gone anywhere in a decade. They need to do something, and they're not going to do it with gold. Gold's not going to do anything. And so obviously technology is going to help them. And obviously the trend that we're seeing right now is in AI. And all of these data centers are being built. And if you want to check out the free newsletter, I spent the month of November really looking into the data center business. And I covered multiple data center stocks, whether it's CoreWeave or Oracle or IREN or Nebuous or TeraWulf. And I went into it with an open mind. We even had clients in Oracle, and we made 73%. This Substack was actually one of the first Substacks to ever talk about Nebuous over a year ago. It was in December of 2024 that we talked about Nebuous and told people to buy it. We had sold that for 220% gain. Even went to a Nebuous event in San Francisco and spoke with management. And so it's a company that we were relatively bullish on. But when you looked under the hood of these companies, it wasn't good. Wasn't good. The easy money, if you will, is over. And so one of the trends that I'm seeing right now in AI is that NVIDIA chips are way too expensive and way too complex for inference. Okay. And this goes right at the heart of their acquisition. So they bought this company called Grok. Now we say they bought the company, it's an exclusive license, and it really was done to get around regulations. And it was really so the executives over at Grok and the employees over at Grok, I saw on X, they were literally at the NVIDIA offices on Monday. The acquisition was announced on Friday. And if it was a true acquisition, it would take months into next year for the companies to combine. But it was an exclusive licensing agreement. We'll put that in big old air quotes in 2026. And so the Grok headquarters basically migrated right over to NVIDIA over the weekend. And it plays right at this trend that NVIDIA chips are far too expensive and complex for inference. Now, what is inference? It is the reasoning or the running of the large language models. If you are Chipotle and you want to streamline HR or streamline scheduling or streamline something in your business to make it a little bit cheaper and to cut cost, you're running that on top of some type of large language model. That obviously has to run through some type of computer chip. Same thing when we are on ChatGPT and we're asking it questions and those types of things, then, like that is inference. That is reasoning. Thank you, the great one, 428 with the $1.99. Thank you so much. Appreciate it. You are the great one. Really appreciate it. Now, in terms of things getting cheaper, Mark Benioff is the CEO and I believe the founder of Salesforce. He's been very vocal about this over the past couple of months since the company reported their earnings. And he is pointing out a trend that I am seeing. This is really, really a key point. There's a lot of people on social media. There's a lot of people in the AI that kind of like critiquing AI from an investment standpoint. They're pointing out what Mark Benioff is going to point out and what I'll discuss here in a second. And they want to think this is negative. They want to say that this means that NVIDIA's, has to crash or the AI bubble is going to burst. I'm going to show you that what Mark Benioff is pointing out is actually showing you that the AI bubble, if you want to call it, hasn't even inflated yet. So I'll show you what I mean by that. But he's saying AI is on a wicked race to the bottom. And to a novice investor or a newer investor, they read this and they're like, uh-oh, the AI trade's over. I got to get out. The price is going down. I'll show you here very specific, like a very specific example, why this actually means that the AI race is exactly where you probably want to invest in 2026. So Grok has gone down. It's 28 cents per million tokens. We don't need to get into what a token is if you don't know what it is. It's really the output of the AI. The thing to understand is when ChatGPT 4 was launched in 2023, it was $37.50 per million tokens. Now you're down to between 10 and 50 cents, depending on the model and the output. Here it is from a graphical standpoint. You are seeing that you have this massive collapse, if you will, in terms of pricing when it comes to AI. So the cost, if I am using ChatGPT, if I am a business, this is the most important thing. If I'm a business and I have a large language model that is handling customer service queries, so I can handle those better and maybe eliminate some cost in terms of employees. Well, a while ago, it was costing me $37.50. In fact, you couldn't even run a profitable customer service business at $37.50, but now it's down to 28 cents. And so as this plummets, this is amazing for, again, the companies and the businesses that need the help. So what does this remind me of? So Mark Benioff is pointing out, hey, we're on this wicked race to the bottom. He says, look out below and let's go. He's a smart guy, obviously. Started at Oracle, started at Salesforce. I mean, this is a veteran of tech, if you aren't familiar with Mark Benioff. And here we are, the price is collapsing. What does this remind me of? This reminds me almost perfectly of the cloud. If a lot of you were I was in web development kind of in the early 2000s. And so I remember when it was, you were all on-prem in the beginning, and then the cloud started showing up in 08, 09, 010 with Amazon AWS. And the price, literally basically by the month, kept going down and down and down and down. And now we're at a point where, and this is cloud storage, and it's one aspect of a cloud, but you basically have flatlined at something that used to cost 16, 17, 18 cents. My guess is this per gigabyte per month. Now you're down to pennies in terms of storage. Okay. So the large language models collapsing in price, what does that remind me of? It reminds me of the early days of the cloud. It was, quote, expensive, certainly compared to now, and that the price quickly dropped. Now, you will see some investors that weren't around in 2010, 2011, don't even know what AWS really does, or don't understand it from a fundamental perspective, or that when price drops, it actually is a good thing, okay, for everybody. We'll talk about it from Amazon's perspective in the cloud. Obviously, cloud's been a great business, but it's been great for other businesses. So what this doesn't mean is that LLM companies like OpenAI and Gemini, it doesn't mean that they're doomed. So I see people see what Mark Benioff posts and that price is collapsing, and they're like, oh my God, the bubble's bursting, it's over. That was, if I were to go into a kindergarten classroom and ask them to analyze this situation, that's the kind of analysis I would expect out of a kindergartner. Okay. It's not intelligent way to look at this. Okay. And the other thing that I see is AI companies won't make money. It's the other thing that, as the price collapse, oh my God, they're not going to make money. Here's the deal. As the price of AWS plummeted over a 6, 7, 8, 9, 10-year period of time, AWS was a great business, right? The cloud was a great business. The cloud was a great business for Amazon as price was collapsing. But there was companies that did even better. We'll call it Cloud 1.0, flashback to 2006, 2007, somewhere in that range. The Netflix and the Ubers of the world were setting up their business. Now, Netflix was pivoting away from a physical hardware business. We don't need to talk about that. They don't even run that business anymore. But they were pivoting to a streaming business, which we'll talk in depth here in a second. But you also had Uber as well, that was basically pioneering ride sharing at the time. Okay. This all happened right, and it was all enabled by Cloud 1.0. Let's look at Netflix in particular. So Netflix was a software wrapper for Disney content that was hosted 100% on Amazon AWS. Let's unpack that, okay? Netflix didn't own the content, okay? Netflix didn't even own the content when it got into streaming, okay? We know Netflix today, it has series that it owns or controls. Netflix didn't own any of the content it had, okay? It was a software wrapper for Disney content that it licensed from Disney and paid Disney to show on its platform. And it hosted 100% of all of that and delivered the content using Amazon AWS. In fact, it still does that today. So Netflix didn't own anything. It didn't own the content. It didn't own the data center. It didn't own the chips inside. I know there's all this discussion these days. You'll say, oh, you've got to be vertically integrated. And yeah, it works for Google. Okay, we'll talk about Google here in a second. Yeah, that absolutely works for Google. It works for some companies to be, have everything vertically integrated. Okay. But for Netflix, that was just starting out, that was a relatively small company at the time, owning nothing was the right strategy. And how did it work out for Netflix? Netflix announced that it was going to stream other people's content on somebody else's cloud computing platform. They announced that in 2006. 14 years later, Netflix stock went up 21,000%. Can you believe that? Netflix stock went up 21,100% in about a 10 or 15 year period of time. In fact, I believe it's one of the best, if not the best performing stock over that era. So a company that didn't own any of the content, at least for a portion of that rise, and still to this day don't own any computer chips, doesn't own any of the cloud. I mean, it probably has some of that stuff internally at this point, but it is all outsourced. Here's what you need to understand. The large language model is the new cloud. It's not the end all be all. It's not, oh, OpenAI is the only cloud that is the only large language models that exist, and everything is going to be done on OpenAI, and nobody else is going to be able to exist, and all this other stuff is going to go away because the LLM is going to do anything. No. LLMs are simply software application layered on to the new cloud. That is exactly what Meta has correctly identified. And a company like Manus is basically a play at the software layer of AI. Manus doesn't own anything. Manus uses Claude LLMs from one of the tokens I showed you. So they basically, and they have collapsing price too. That's the great thing, is if you're Manus, when you launched your website or launched your web app earlier this year, your costs were probably double or triple what they are now. So your costs to deliver your product are collapsing. And so you're using LLMs, you're using some open source LLMs and fine tuning it and adding your expertise, very similar to Netflix. Netflix didn't own the content, but what did they do own? They did own the software wrapper and the application and the recommendation engine that would send you to watch a Disney show. That's basically what they did in the early days. Same with Manus. They're just wrapping software around a Claude LLM and some open source stuff. They're hooking it into browsers and files and kind of tying it to user intent. Manus became one of the fastest growing software stocks of all time, going from 0 to $100 million in ARR in 8 months. This is what's happening. And we have to go back to the early days of the internet to realize this is exactly what happened in the early days of the internet. We all think of Google now, they vertically integrated, blah, blah, blah. But they didn't invent the search engine. They didn't invent the browser. They sure as hell didn't invent email. They didn't invent workplace software. They just copied that right off Microsoft. They didn't even invent Android. That was an open source thing. They didn't invent YouTube. All Google did was they wrapped all of that stuff into an interface. And the most important thing is they got distribution for it. So what do you guys think Meta is going to be able to do? They're going to be able to find the software layer of AI, and they're going to be able to distribute it to billions of people around the world. It's probably going to be a pretty good business. But back to NVIDIA. It will continue to dominate training because, like I talked about, their chips, NVIDIA chips, they're too expensive and too complex for inference. You can't have these plummeting prices and have GPUs that not only cost a lot from NVIDIA, but they're very expensive to run. Obviously, you're aware of the power and the cooling and the complex nature of these things. The chips need to get way simpler and way cheaper. And that goes back to the acquisition of NVIDIA buying Grok. Grok makes what they call an LPU, or I think a language processing unit. It's essentially a specialized chip that processes the inference or the running of the chips. Now, the good news is for you and the investor, you're probably invested in NVIDIA. They're going to capture some of that market. The good news for you as an investor, there's other stocks out there as well that are going to benefit. It's not just going to be NVIDIA. The top of that list is obviously going to be Broadcom. They not only have the chips, they have a software layer, but also more importantly, the networking layer that applies there as well. And so that is where we are heading in 2026. We are going to have advancement at the chip layer. You are going to have a broadening out of chips that are used in the data center for AI. Right now, it's NVIDIA. It's a little bit of AMD. It's a lot of Broadcom if you're Google, but like almost nobody is Google. Okay. Google is, like the Michael Jordan of what it does. And so it has access to things other people don't. But as we move into 2026, there are numerous companies that are going to play at the chip layer, not just NVIDIA. In fact, NVIDIA, I don't want to say they have catch up, but what they are going to find is the Adobes, the Trade Desks, the Chipotles, the PayPals, the Novo Nordisk, the Targets of the world. They don't have any interest in training a large language model. They don't have any interest in that. All they want to do is run software applications to help them lower costs, streamline supply chains. If you're Adobe, you just want to be able to serve whatever AI application you're layering onto Photoshop or Premiere Pro. You want to be able to just layer that on seamlessly at the software layer. And in some cases, the best software stocks going forward are going to own nothing. And I see people criticize stocks out there where they're just a wrapper for AI, or they don't own the data center, they don't own the chip, or they don't own this, they don't own that. Yeah, NVIDIA didn't own shit in 2006, and it was basically the best performing stock. That is where we are heading. LLMs are going to become the new cloud. That is super exciting that we have a cloud 2.0 coming, and Netflix style companies. And the other one I pointed out was Uber. Uber didn't own any of the mapping technology. Uber didn't own any of the cars. Uber wasn't hosting any of this stuff on their own, software engine or anything like that. Uber was the same way. Uber was just trying to connect riders and drivers. And that's what it did. Is NVIDIA selling H200s into China? Confirmed 100%? Yes. Yep. You have 100%. It is 100% go. So China did their little song and dance about the H200s, but their companies want them. Their companies need them. And those are going to go in. Now, I want you to be prepared for the layer of software and chips heading into 2026. Our subscribers are in the chip layer, NVIDIA, Broadcom, obviously, but there's other chip players there as well. And on the software layer, I think there's some very specific companies that you absolutely want to be looking at the current time. I mean, Palantir is a great example too of, I know most software like got blasted this year, but Palantir is a great example of like they don't own the chips, they don't own the data center. What do they own? They own the application layer. And clearly it hasn't hurt their stock at all for 2 years. And so this is not that all software stocks are going to perform like this, but that is what's coming. That is absolutely what is coming. Now, before I add Aria here, I do want to try to fix my audio so I can hopefully hopefully hear him. But we'll see if I can just mute my mic if I'm not able to hear him. That sucks. I'm going to add him and then we will deal with the audio issues if we have them.
Hello, hello.
How are we doing, sir?
Good, good. How are you?
I am fantastic. Aria, why don't you tell people out there who aren't familiar maybe with you, uh, give them the 5 minute spiel, and then
Yeah,
we'll
absolutely.
dive in. We've got a couple of stocks I
Definitely.
think we agree on, a couple of stocks we disagree on. So
Definitely,
I think
definitely.
we'll have a good one here. Hope you're
I
having a
agree, I
good
agree.
new year. Thanks for joining me. And
Yeah, of
so this is
course.
Aria of Quality Invest.
Yeah, absolutely. Thank you, Colin, for bringing me on. I know I've mentioned it to you privately, but I've truly been a fan since like the first month of me investing. I started investing in 2021. So it's honestly kind of a surreal experience to do like a stream with you here. But yeah, more in terms of what I do investing wise. So yeah, the name used to be Quality Investing with Arya. I would say that's how I kind of generally started. Businesses like Mastercard, S&P Global, those like super wide moat style companies. I've shifted a little bit more into what I like to describe as like the Bill Ackman style of investing. So it's still strong moat companies, but these are businesses that like they don't have to have these super dominant 50-year long moats and this and that, and a little bit more emphasis in terms of the growth. And I think the biggest key for me, at least over the past year, has been I don't subscribe anymore to the buy and hold forever style of investing. So like there's this notion out there like Def Cantasaria or whoever, you got to buy Mastercard and hold it forever, and compounding machine, this and that. I don't subscribe to that anymore. It's more hold on to these strong moat businesses until they're either drastically expensive, or if you happen to find a better opportunity elsewhere, feel free to kind of swap around. And I have done that. I know you just mentioned you think Google is the king and this and that and whatever. Earlier this year, I did sell Google for a sizable Adobe position. So I'm
Nice.
uh, I'm happy to kind of dive into any of those topics. But yeah, that's the gist of it all.
Okay, so you sold Google
Yeah,
to fund. I'm assuming you probably got Google at an amazing price,
average was
and
153.
average was 153. So you almost got
Yeah,
it at the bottom, or at least of the recent rally that it's gone on. And you sold it, I'm assuming, in the 300s or high 200s.
296 or 295 was the average sell price. So I bought in like 8-9 different tranches. I
Sure.
sold in 3 equal weighted tranches at 296. So yeah, basically kind of sold towards the top there. It was just a valuation issue for me. And the gap 30 times trailing PE is, in my opinion, understated. They have those SpaceX investment gains that I think you know about, right? And
Yeah.
I think those are kind of overstating the earnings, in my opinion.
Mm,
Even if they do IPO and they do sell their stake, when you lap that quarter next year, that's like essentially a headwind to the earnings, right? So
sure.
true PE, in my opinion, is closer to like 39, 40 times or thereabouts.
I see. So you're applying, so the PE that shows up on the websites or in any types of calculation that people are doing, it is including that unrealized gain, which I think shows up in the operating statement somewhere,
Yep.
and then
Yep.
positively impacts net income when it's obviously like SpaceX and it's going up. But then, like you said, if as that investment matures and they IPO, or even if the shares like SpaceX goes only from an $800 billion valuation this year to 810 billion next year, which would still be a really sizable growth for a company even at that size, that now you are not getting that strong uplift of EPS, if you will,
Mhm.
and it is skewing the valuation metrics that you see of Google on the different websites, or if you calculate these things yourself.
That's exactly right. So I think just off memory, Google does, I think, 125 billion of net income. I think the non-operating income is roughly 25 or thereabouts. So I mean, that's 20% of the trailing net income is investment gains. Now, of course, not all of that is SpaceX on its own. They do have investments in other businesses, but I would estimate somewhere like 85% of that is just the SpaceX gains. So yeah,
Sure.
exactly. It skews it up quite a bit.
Right. I'll show this to everybody if they're watching and they're not just listening. You have this other income line on a, like, this is basically your P&L statement. Public companies call it a statement of income. And so you have the Google results come up here. So their revenue in the most recent quarter was 102 billion. And then obviously you have all your cost and you have your total cost and expenses at $71 billion. And so you get this income from operation number at $31 billion. And what I tell investors is stop right there. Don't go below that, because what does Google have less control over? Income taxes. They have very little control over income taxes, depending on who's president, what the laws are, whatever. That can fluctuate, right? And also, they have other income. Other companies pay. Google has some debt, but they're not paying a net debt on it, and so you can't control fluctuating interest rates, right? And so, yes, if you're a heavy debt company and you've piled on a ton of debt, and certainly there's examples of these companies out there, and interest rates start to climb, it's going to just kill your net income because that is factored in after that. But in terms of a company like Google, where it's relatively clean after the operating income side, I tend to focus right on here. And so, yeah, our revenue in the most recent quarter went from 88 all the way up to $102 billion. But if you notice, the income from operation was a slightly more modest increase from 28 billion up to, I would say, just, it's still incredible numbers here. Okay.
Yeah.
Up to just $31 billion. And we're not talking about revenue here. We're talking about operating income. However, as Aria pointed out, you have this other income. Some of this is going to be some of the income that they're earning on their $100 billion, but some of this is also unrealized gains from their quote other investments out there. 3.2 up to, I mean, 12.8, $12.8 billion in a quarter of other I'd love to, wouldn't you, Aria, wouldn't you love to have $12.8 billion of other income?
It would be nice.
You know, it would be nice, right? And so then you come down to net income and it paints a more rosier story because, as you pointed out, that there's this other income. And so, like what you've talked about is coming forward next year, you lap this quarter where you had this $9 billion, $9.6 billion of growth on your other income. That is probably not going to reoccur. Now, they might realize the gain and then that gain gets dumped onto their balance sheet. And so there's, some push and take here. But what I would encourage most investors watching, for most companies, is stop at the income from operation side. And if you want, maybe you're more analytical than I am, but there's probably ways to draw the valuation metric from this 31 billion number rather than the 34 or 35. Or if you look at a year to date number, look at the other income. I mean, it's $26 billion. I mean, it's over a quarter of their income from operations actually comes from quote other income. Now I understand this company has a mountain of cash. In terms of tech, they have really overtaken all of the other companies, primarily because it's not offset by as much debt. They have a lot of debt, but it's not nearly as much as Apple or Microsoft or even Meta, I think, at this point. And so they are, in a higher interest rate environment, it'd be also nice to have $98 billion sitting in the bank account earning 4.5% or whatever they happen to earn on that. So some of that is baked in there as well. But like you said, if you look at the websites, they are factoring on this EPS of, we'll call it $8 diluted. This $8 diluted includes this $26 billion of other income, which is not related to the core business of Google. So I just wanted to show that to people just in case, because this comes up a lot, actually, when you're analyzing companies and you're looking at them. This situation comes up a lot. Now we're looking at we're looking at the shining example here. And if there's a company that can get away with this type of stuff, It's a company with this much cash and this much free cash flow and all that type of stuff. So, but when you get down to the thinly profitable company, the unprofitable company, the mining company that isn't going to hit gold for 3 or 4 years, then all of this stuff really, 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 really matters. And the stocks will trade almost exclusively on this type of stuff. So if you know how to analyze it, I would say it's easier to understand in Google's sense. And so if you can take what you learn from Google and then go apply that to somebody else, then I think it certainly helps. Sorry, I
Yeah.
interrupted you. I just wanted to I wanted
No,
to
no, no.
show
That's
that
that's
from
great.
kind of a better example. But anyways, I think what we were talking about is you sold Google and you
If I
dumped it
can,
into
Colin, just
Adobe.
very quickly, if I can
Yes.
add as well. So, like a substitute that I generally encourage is to use the EV to EBIT multiple, EBIT just being operating income, because then exactly like you said, you
Uh,
stop at that operating income line. You don't have to deal with any funny tax stuff. You don't have to deal with investment gains. It's not a perfect ratio, and no valuation ratio at the end of the day is perfect. But I've found that covers the widest umbrella of stocks in terms of kind of like working for most mature companies, companies we typically look at. Again, of course, if you're looking at unprofitable gold mining company, you know what? I don't think it's going to work out in that scenario. But for the most
sure.
part, it's my favorite ratio.
Yeah, and I think the lesson there is you have to be a little flexible, right?
Of
It,
course.
it depends on the company or the sector. And this is why when you look across Wall Street, people tend to specialize, right? There's like energy guys and there's finance girls and there's people that only do value stocks and there's people that only do bonds. I think as you get older, you tend to like find that lane where you want to operate in because like you said, there's some nuance that applies to maybe one company or one balance sheet or one business model that then doesn't really apply. And this is the mistake I see a lot of newer investors. They take something that they learn maybe in Finance 101 or they see applies to one company and then they try to go apply it to somewhere else. And it doesn't it does work sometimes, but I think as you're pointing out, there's a lot of nuance to these things, and the more knowledge you have about it, I think it's going to make you a better investor. Now that we're in 2026, I think that's what everybody has a goal of. And so you piled into Adobe,
Yes.
and what's the price on Adobe, or roughly the price that you're into this one at?
I think it's 335. So again, it was multiple buys, but yeah, I mean,
Okay,
I think I opened the position, I want to say in September. So,
okay,
September, October was kind of when I was accumulating.
okay,
I today think the business should be worth at least 450. And then there's a very real world where,
okay,
it accelerates, it kind of regains that premium valuation it used to have. You're looking at a stock close to maybe $600 in terms of price. I don't know, maybe a year and a half down the line with a proper re-rating.
okay.
So that's kind of the thesis
Um,
with it. We can go more into the threats, the AI threats, the Canva Figma threat. I know you were using Canva earlier, so we could double click on any of those things. I'm happy to kind of discuss it.
yeah, so I mean, I think I don't know how old you are, Aria, but I might have been using Adobe software before you were even born. So
Probably,
I
probably
I
take a guess.
I'm I'm guessing you're in your mid 20s.
I turned 20 recently, actually.
Oh Jesus. Okay,
Yeah.
so I mean, you're getting old when you're whiffing on. So yeah, I've used Adobe software for longer than you've been alive.
Okay.
I'm very fond of this company. This company has put multiple zeros into my bank account over the years
Mm,
when it comes to web development and Photoshop, and I still use Premiere Pro today.
mhm,
However, what I have found is, and this is pure anecdotal, but
mhm,
I think it does illustrate some of the change in terms of what Adobe has to address over the past couple of years. Is in the past, 20 years ago for sure, easily 10 years ago as well, Adobe software was unreplaceable. Okay,
mhm.
there was absolutely no replacing it. You had to have Photoshop, depending on what you were doing from a work perspective. But I would subscribe to the Creative Cloud, and I would use all the like a huge suite of the apps. For me, it was like 4 or 5. I know some people, if you were into Illustrator, and depending on what you're doing, I was doing a lot of different stuff, video, Photoshop, and those types of things, tying it all together into a website. It was irreplaceable software. I will say, with the advent of Canva, I don't use Figma, but I know people that swear by it.
Mhm.
There's also CapCut, which I also pay for. I mean, I'm the king of paying for software. Like I have a software bill that the companies love me. But what I have been able to do with Adobe is I've actually downgraded. I think I was paying 50, 60, $70 a month on whatever the top tier cloud plan is. Now I only play for Premiere Pro. And quite honestly, if I wanted to be cheap or if I wanted to cut out Premiere Pro altogether, I could. And
Mhm.
this is the first time in 20 years where you could do my job, whatever it happens to be, whether I don't do as many websites anymore, but you could cut out Adobe almost exclusively. Now, that doesn't mean it's a bad stock because as I'm sure you've seen, the company in a quarter is doing $6.2 billion in revenue. You're still growing. It looks like, what is that, 10% growth or so
10,
year over year?
11%. Yeah.
Massive gross margins. Okay. This has
Yep.
been the hallmark with this company. And that's what the beauty of investing in these mature software stocks is. They paid, it's hard to say this with a straight face, just $650 million on that. This is a subscription revenue or cost of revenue, if you will, on the 6.2. So you have this 5.5 where you got R&D, you got sales and marketing, which is ticking up. The one thing I get a little concerned about is, you're increasing your sales, but it also is coming with increased marketing spend as well on a recurring business model, not nearly as a problem, but your total operating expenses are growing as well. Your operating income looks good. So what are they going to do with this cash, right? They've got some, I mean, this isn't Google, but it's hard to look at Google and then go look at somebody else's balance sheet. What are they going to do with the operating cash flow? 3 months ended, you printed we'll call it 3.2. You're going to buy back $2.5 billion worth of stock. That's in a quarter. Okay. And they did that last year too. My guess is that's kind of the run rate they're on.
Yep.
There's no dividend here, I don't think. I will tell you, and I don't I can't speak for you, but I don't think you apply this into your analysis. But
Typical.
everything that I saw with Adobe here is good. Like good. It's not like, could it be better? Yeah. Fundamentally, if you know the software and the business as well as I do, fundamentally it's not as clean as it used to be in the past, but we can get over that because these financials are still good enough. And there's a lot of corporations that aren't going to use CapCut, that aren't going to use Canva, or will use Canva and Adobe and that type of stuff. So their business is not going anywhere. And I do believe one of the things that I talked about is at the software layer, companies like Adobe are going to be and they already done this, layer in the AI tools that they are licensing the AI applications from a Claude or an OpenAI or whoever they happen to do it. They wrap it like Manus does or any of these other applications, or even like a Palantir does, and they'd be able to charge for it. The one thing that is keeping me from buying Adobe is this chart.
Mm-hmm.
This is as ugly of a chart as you will see, and you'll see that it's done this before.
Yeah.
And so what I wait for is a break, and we are here with Adobe, and so this is exciting that we are looking at this. You are here at decision day. Either Adobe is going to break out of this channel and is going to create a breakout candle. These are very exciting candles. When they show up, it's exciting. You don't have to buy them because what often happens is a back test.
Mm-hmm.
Now, the back test is where I would buy this one. So it's like, hey, the stock is 351. I would buy the stock at 351, but I would need this candle. Otherwise, what happens is this is just the retest of a top of a channel. Let me reset my thing here. This is a retest of a top of a channel that we've been in for 2 years. And what are we going to do? We're going to come back and make a new lower low. And that's what we did during this. I can't use my chart software today. That's what we did during this time. In fact, you actually had a breakout here. I was looking at this other day. I was like, oh, should I buy Adobe stock? You did a breakout. Look at this. This is back in 2022. You did a breakout. You did a full back test of channel. I mean, this is textbook technical analysis. I would, and I may have, I don't remember. I probably did buy this stock right here. Okay. And I was like, ooh, it's bouncing. It's great. Then you had some kind of gap down. Must have been like earnings or something.
Figma. The Figma
Oh,
failed
Figma.
actually
Oh,
no, when
okay.
they announced the acquisition, yeah.
Oh, okay. Okay, now that's making sense. And so sometimes earnings and fundamentals screw with the technicals, and that's what happened here. And so this was a failed breakout and a gap down and a retest of very long-term trend. This is a rare occurrence. Usually, minus without the Figma thing, this thing probably would have found footing here and then done that rally without this little bottom thing. So you could
Mhm.
almost ignore this. And so that's why I don't mind the level that you bought it at, because it's either going to hold that level and the bottom is in, or it will come down here and retest this 260 area and you're just going to have to double down on it. That's kind of how I see it. But me personally, being an old man and having kids to feed, I'm assuming you're not married, you don't have kids yet, or is that
No, not
you're
yet,
20,
no.
so it's tough.
Yeah,
Yeah, it's tough.
yeah.
Still working on that. Uh, kids these days, they should start on that. I'm waiting for this breakout.
Yep,
When I was 20, I would have bought this one already.
great.
But when you become an
Yeah,
old man like me, you wait for this, you wait for this move, and then you wait for a retest. That's so I think
yeah.
we kind of agree on Adobe. Um, I don't know if I would have sold. I don't know if I would have sold Google to buy Adobe.
It's a bit bold.
But who am I? It's a bit bold, but I think you showed your performance on X this year or last year for
Yeah,
2026. And I think you were at 28, 29%,
29
28.
percent.
So what you don't need me critiquing that. I think the S&P was up 16. The Qs, my guess is you're heavy technology.
Yeah, so I mean,
Um,
Amazon. I think I have the portfolio pinned actually at the top there. The very
okay,
first
that's
post.
right.
If you want to pull it up
Let's see
after,
what the Qs
uh,
did. Qs were 20. I would I like the
comp
benchmark
against
at
the
SP
Qs.
is fine. Like yeah, I would comp to me like going forward based on this composition where you have Amazon, Adobe, ASML, Uber, FICO. We'll have to talk about Zeta if I'm saying that right, and
Yep.
TMDX. We'll talk about those here in a second. We'll go to Uber next. Um, but yeah, I would comp against the Qs. Not I'm like splitting hairs here. I mean,
Mhm.
28%. Like, look, I think even people that like whatever the SPY was up this year, 16% or whatever. Like, even if you were at 8, 9, 10% over the past year, like given the year that we had, it's still a very good year. And depending on your strategy, right? If you're an
Mhm.
older guy and you're going more towards maybe dividend payout, or you're getting ready for a payout, or let's say you're getting into your late 40s, 50s, maybe 55, and you're looking for that rotation out of the aggressive growth into safety and preserving your wealth, you don't need to do 16% at that stage. When you're
Yep.
20, like Arya, yeah, you should be pushing the Qs. You should be looking what the Qs does. And I don't even know, like I don't think the Russell had a good year. That's IWM, I think. Yeah. Russell 2000, 11%. So
Well,
small caps
that's a
are still
very
lagging.
flawed, very flawed ETF to begin with, right? Like once it kind of exclude or like it gets rid of the companies that perform the best because it's looking at the market cap. I don't know exactly
Oh,
what the market
sure.
cap restrictions is, right? So similar to
Oh, I see.
SCHD, by the way, the biggest winners end up kind of like graduating out of the ETF. So I
I
just
see. I see. I see. I see.
yeah,
Sure,
these
sure, sure,
are
sure, sure.
I don't love these ETFs.
Sure. I think what we could do is like if you're 20 and you're looking for like FOMO, like not FOMO, but YOLO type performance, I think you could peg your performance against like a Palantir,
Uh,
maybe like SoFi,
I don't know about
Robinhood,
that.
because like the high flyers, if you will. So you
Okay.
take a basket of the high fly. I mean, this thing's up 200%. Palantir's up 135%. SoFi is up a big one, 70%. So there's these kind of like core like stocks that go up. Not that you have to go up that much, but that's the secondary benchmark that I would look to. If you're young and you're all growth and your portfolio goes to zero and it doesn't matter, like kind of thing. Aria, I'm not saying that applies to you. You appear to me that you've graduated out of that, right? And so, but to the young guy with $85 in his Robinhood account,
Mhm.
like it doesn't really like if you match the SPY on 800 bucks, like who cares? You know what I
Right.
mean? So, and how much did you learn? Whereas if you were pushing yourself a little harder, different strategies, different portfolio mix, at a younger age, that I think is a wise thing,
Yeah.
in my
I mean,
opinion.
when I actually initially started investing in, I literally timed the perfect top in 2021. By the way, like the month I started investing, it was the top in the S&P. But yeah, when I started, like I didn't know anything. I was buying like kind of conservative stuff, but like
Sure.
I was buying like Walmart and stuff like that. But my very first investment was AMD, and I made like
Okay.
10% in a week. And I was thinking to myself, oh, this is the easiest thing ever. You know what I mean?
Right.
Let me just do that again. And then in
Yeah.
pretty short order, I'm buying, Tesla, I'm buying Nvidia, I'm gambling on earnings. I
Sure.
lost the one quarter where Netflix lost the subscribers. I gambled on those
Yeah.
earnings and lost like 25%
Yeah.
in like 2 days. So, you know,
Yeah. That's
as you say, like when you're starting out with a very small amount of money, absolutely, it's great to make those mistakes early on, lose a couple thousand. It is what it is. Thankfully, I'm in a position where my portfolio is now a little over 100,000. So
nice.
it should probably kind of dial back the risk, but at the same time, I do have those like smaller growth bets, right? Like Zeta and TMDX, I would say, kind of serve that purpose for me, where those are companies that could, for example, TMDX I think was up 90% this year. So size is smaller, but still have exposure. Yeah, 95%. Um, so size is smaller, but still have exposure to those, as you say, growth names. If we could quickly go back on the Adobe stuff, I do a little bit of TA. I don't make videos about it or anything, but I do for like entry and exits and stuff like that. I have a similar chart drawn, but slightly different. And yeah, we could kind of try to optimize our entry on that front. But just fundamentally speaking, I think the business is sound as ever. And then more in
Sure.
terms of, I think you mentioned how for the first time ever, we could, you can make like YouTube videos, for example, without an Adobe subscription or do sort of creative work. That's 100% true. But the thing is, and I think there's this big misconception out there. And even if you asked me 3 months ago, this is what I thought as well. We're not the ideal Adobe customer. We're not the target Adobe customer. We're bucketed in consumers and in freelance and stuff like that. We're very low average revenue per user customers for Adobe. Maybe we spend $30 on Premiere or whatever the case is. 90% of Adobe's revenues comes from business or enterprise use cases. So this is the marketing department of Pepsi, the marketing department of Disney, the people working on Disney movies, like genuine, real professionals that rely on it day in and day out and are using it for multiple hours on end, similar to how like a Salesforce is used for, sales and service people in enterprises globally, right? So that's why you see when you look at the financials and you compare it to like what we see anecdotally with, using it for example, YouTube, or you see the come up of Canva and CapCut and all these sea of competitors, the two doesn't match. How is it that the company's still growing 10%? Price increases, yes, but that's only maybe a 3-4% boost annually. So how is it they're growing pretty solidly still? Meanwhile, we're seeing the sea of competitors. And, these companies are not new. Canva was founded early 2010s. They have, I think, 400, maybe 500 million customers. CapCut has over 1 billion registered users, 1 billion, right? And so how is it that hasn't left a dent in Adobe? It's because those are mostly free customers. So Canva, with their 500, 400 million subscribers, does 3 billion of revenue. Adobe does 22, 23, 7 times more revenues with 10 times less users, right? So it shows you sort of like who the customer really is. And so that's kind of like a point of contention that I think a lot of people miss. And again, like this was my misconception just 3 months ago as well. Yeah.
Sure, sure. Yeah. I think, I think the business has evolved a little bit, but has it deteriorated as much as the stock chart has deteriorated? I would argue probably not. And I think that if I were to draw, I still do, like there's these green boxes that I would draw on these charts to just remind me when to buy.
You're at
And
the
then
top
if
of it.
if if I were to draw a green box on Adobe, it would be right there. And it would be any inside of this box is where I would buy it, and I would not want to see it get below 260. You get below 260, and you are in uncharted territories for the past, that is 7 years you haven't gotten underneath that level. And so I would not want to see it get below that level, just based
That's
on
PayPal
where I'd be.
territory.
Yeah, right. So I mean, like the PayPal chart, there is a technical term for these types of charts. Why are my charts like there? That's better. Like yeah, these humpback whale charts where they go up and then they come down, and then although PayPal looks, I mean, there's a spot here where it needs to hold this level, but I may or may not be buying PayPal here at some point. Stop loss at 55, buy it at 58, sell it up here at 78. I mean, that to me looks like the setup, although that's kind of a lower high. So it's not like crystal clean here. But this is a breakout of a downtrend. It's not a large parabolic move. You've done the full. Here's like a really good example of breaking out of a downtrend. So PayPal is in this epic downtrend. Like, first of all, it's super steep here. Then it flattened out. Still in a downtrend, it just flattened out. And then finally you broke out. Full back test. So you leave that line on. And that was the moment to buy, was right there at the first moment to buy in years. Buy there, and you'd be sitting on no gain right now, but it to me this looks like it wants to bounce. That's PayPal. I don't know. I don't really like PayPal as much. I mean,
Yeah,
I
me
use
either.
PayPal all the freaking time, but it's not from a stock perspective. Here's one. This is one that I've ruffled some feathers on. This is good old Uber. And Uber is in a beautiful uptrend. I would buy Uber right at this level. This would be an area, not like all in, but this is an area that is held for 2 years. The level where Uber is at right now.
Colin, if
Yes,
I can
it's rolled
ask,
over. Yes.
are you still a little bit bearish on, longer term Tesla AVs, all of that? Are you still?
Um, so here's my view on Uber. And I think people in the investing world, they're trained because they watch sports, and it's the Lakers win and the Celtics lose. Or
Mhm.
if they watch politics, it's Trump wins and the Democrats lost. It's win lose. As humans, there is kind of that like nature to look at everything as win loss, binary. I am not somebody that thinks. Now, I probably did a video where I did a chart of Uber going to zero or something, but that's all like clickbait and get people riled up or whatever. This is a company that's going to be around for a very long time.
Mhm.
This is a company that is going to participate in the autonomous vehicle, thing. And if we have a moment, we'll talk about their parking acquisition, or the rumored one. I think that was a smart move by them. It's showing you that they have vision. I would be
Mhm.
short this company if they didn't have the quality of CEO that they have.
Mm.
I look at things from a leadership perspective. If you have shit leadership, there's some great examples. Intel, not the Intel guy now. The Intel guy
Singer.
for many, yeah, I mean, even before that, there was another guy, I can't even remember his name. Terrible leadership. Okay. Lip Bhutan comes in. I dog shitted on Intel stock for a long time. Lip Bhutan came in, and I was like, I'm in, and that, clearly. Nike, terrible leadership. John Donahoe, absolute moron. Finally got rid of him, and the stock goes up. Boeing.
Starbucks as well.
Um,
Laxman for like a year and a bit.
yeah, I mean, he was there so short that it was um the
Fair
Boeing
enough.
CEO, basically their mismanagement had people die. And so this guy should be in jail. He doesn't have a job anymore. The CEO that Boeing has now is fantastic, and I own Boeing
Novo
stock.
maybe.
I think Novo's slightly more complex.
Mm.
The product was so good. Sometimes you are a victim of your own, sometimes success turns you into a victim. And sometimes so much, there's probably plenty of examples of this in the stock market where the success in the product is so good that it ultimately sets that type of move up for Novo. You're also looking for a breakout with Novo. This is a chart I look at it every day because you're waiting for a breakout because you got a great opportunity with this. They have an amazing product. Their pipeline sucks. I think you asked on Twitter the other day where it's like, what's the difference between Lilly and Novo?
Mm.
Lilly has a better pipeline
Mhm.
of other drugs in the hopper.
Mhm.
And so that's why that stock looks like that. And Novo has one obviously fantastic miracle drug, in my opinion, and almost nothing else. I don't say
Yeah.
nothing else, but what they address are like super rare diseases and obviously very worthy to study and come up with treatments, but it's not, weight loss.
From a revenue standpoint, it doesn't move the needle when you have
Right,
such a successful, one-hit wonder, essentially. Although
right.
I do hear they're trying to work on this like oral Ozempic, and they have like a
That's
6-month
coming.
lead or something. So maybe that
Yes.
chart aligns with the development there.
Yes. The tricky part is the pricing on these drugs have collapsed, obviously. And so, yes, you're going to sell a lot of them. Yes, a lot of people will take them. Yes, insurance will cover them and those types of things. But now it's at a drastically reduced price. And you have other competition from Lilly. And then eventually, it's still 2 years away where you have somebody other than Lilly and Novo making any of those weight loss drugs. At
Mhm.
least 2 years. And so they've got time. And so that's why I look at that one. But back to Uber, they have fantastic leadership. I think so highly of the CEO. The CEO will literally get in an Uber and drive. Like
Mhm.
that is the definition of leadership. Sounds really simple on the surface, but a lot of these idiot CEOs don't do that. This guy's
Mhm.
fantastic. My point with Uber is that this is the best it's going to get because if you go to San Francisco, I'm always shocked when I go to San Francisco. Not by the homeless, not by the whatever's going on here. In fact, that's gotten all of that. It's gotten a lot better. What I'm shocked is I go there every 2, 3 months. How many goddamn Waymos have it gets exponentially more every single time I go. And it's not just, and again, a lot of investors are looking at this Waymo versus Tesla, Waymo versus Uber, Waymo and Tesla versus Uber. That's not how I would analyze this. This is a transportation of people and goods. Uber is the undisputed leader of rideshare, right? Okay. I think we could all agree on that. Revenue, market share, product, everything. They're the undisputed leader of that. Going forward, when you have Google, otherwise known as Waymo, and you have Tesla, and all the criticism, people criticize Tesla all the time. It's no problem. I don't care if people criticize Tesla or not. It doesn't matter to me. However, it takes a minute to get to Tesla's financials. But when you look at Tesla's financials, this is the most underrated aspect of Tesla's business is sitting here on the balance sheet as of September, cash and cash equivalents of $18.3 billion, short-term investments of $23.4 billion. If I were to do some napkin math, that is over $41 billion, $41 billion of cash sitting on Tesla's balance sheet, offset by total liabilities, every liability that they have of just $50 billion. This is as financially healthy of a company, certainly in the automobile industry, but even inside of the technology. This is the most underrated aspect of Tesla is that they don't have to do any fundraising. They don't, if they wanted to go on an acquisition spree, they could go buy Lyft, they could go buy any rideshare other than Uber. They could probably lever their way into going and buying Uber. So this is a very dangerous competitor. If I was again, Uber is the Michael Jordan of rideshare, but it is not the Michael Jordan when he was 20. Uber is now the Michael Jordan after he's won 6 championships. And I'm not saying that he's at the tail end of his career, but he's already accomplished so much. And you have Waymo, who could be I don't know, who's like Luka Doncic or whoever the hot basketball player at this point is.
Doncic.
They're the new guy or the guy on the Thunder, Shea Gilgeous-Alexander or whatever. That's
Canadian,
who
actually.
Waymo is. Okay. Tesla is the Cooper flag of the autonomous vehicle industry. Both have advantages that Uber does not have in the fact of Google and Waymo. I mean, obviously you're backed by Google, which we just went through their financials. It's unbelievable. Okay. With Tesla, you have the expertise of actually making the vehicles. That is something that both Uber and Waymo do not have. They have the vertical integration of that. Not that that's necessarily going to be the defining feature of all of this, but that is something that is very important. They have plenty of cash, they have plenty of capabilities. I understand that Tesla, when they promise something and their timelines are completely out of whack, but they've delivered on everything that they said that they were going to over the history of the company. Not on the timeline that Elon Musk says, but they have delivered on everything. And they are going to deliver on the autonomous vehicle front. I don't think it's all next year. I don't even think it's the year after. And so that's the challenge with me for Uber. Do I want to be buying into where you have Shea Gilgeous-Alexander and Cooper Flag that are younger, faster, maybe better looking, and have advantages that me, the old Michael Jordan, doesn't have anymore? Do I want to be investing in Michael Jordan, or do I want to go invest in the young guys that are about to dominate or come up and dominate? Because it's not necessarily in investing, it's not necessarily all about the numbers, it's about perception. And we can see that with Tesla's chart, right? Tesla's overvalued. Tesla's overvalued today. Tesla was overvalued last year. We can bring up this chart for a long time. Tesla has been overvalued. This entire chart of Tesla goes back to 2010. I can tell you with confidence because I bought this in 2013 on one of these candles. Tesla has been overvalued for the entire time that it's been a public company, but it's about perception. And with Uber, my fear is the perception is you're going up against Google, who has huge advantages. And every time I go to San Francisco, I'm just absolutely astonished with how many of those freaking Waymos are everywhere. And Google has distribution. Google has ability. If I was competing in anything against Google, I would not want to compete against them. And I think they're going to be there with Waymo. I think they're going to be an extremely difficult company to compete with. We haven't talked about Amazon. I'll be at the Consumer Electronics Show next week. Last time I was in Vegas, I saw Zoox, which is hard to spell or hard to say, but there's Zoox, and they're these toaster things. You couldn't pay me to get in one of these. God damn, if you got T-boned in that, you're dead. But this is coming too. And Amazon's, Amazon, to me, it's like, I look at Uber, I love the CEO. The stock chart is fine. Like, I could totally see buying it here. In fact, if it got down a little further, if you got down to the bottom of the channel, you tested 71, yeah, I'd buy that thing. And my stop would be under these lows right here at 58, 57. I'd be risking 13 to the downside that, they hit it out of the park and this thing's 110 in 6 months, 7 months. So, but I think Adobe's the perfect analog to this, right? Adobe's business hasn't fallen off a cliff. In fact, we pulled it up. They're still growing at 10% a quarter, year over year on a quarterly basis. They're still growing their business double digits. The financials look fantastic. They're buying back the stock. The product works. The product's great. But the perception of Adobe is not great, right? Because you got Figma and you got Canva and you got all that. And I would say Adobe is up against not Shea Gilgeous-Alexander or Cooper Flag. They're up against, I don't know what a third tier like Bronny James. You know what I mean? Like I look at Canva and yeah, I use Canva, but I mean, it's not that great. When we're talking about autonomous rideshare and we're talking about Waymo and we're talking about Tesla, I mean, these are two companies that I know they're still in the early days, particularly Tesla, but these companies have proven themselves, and in some ways, Amazon is already proving themselves with Zoox. My fear is that Uber turns into Adobe of the past couple of years, I guess. I don't know how you want to respond to that.
Yeah, like where the narrative kind of drags it down. I mean, that's honestly, I kind of look for those stocks. Like, I've made the most amount of money buying, for example, Google with the ChatGPT risk. I bought ASML when supposedly, there's this China risk. TSMC is a little bit questionable in terms of whether they're going to buy more ASML or the EUV machines, whether they're going to wait an extra couple of years, right? So when you buy when like the narrative is bad and like you kind of look a little bit deeper into fundamentally what the business looks like, that's generally treated me well in terms of my investment. Granted, compared to you, I have had a very short investment career, a handful of years. But I think with Uber in particular, versus let's just say AVs broadly speaking, there's sort of like 5 or 6 maybe things I keep coming back to. And we could go through them all here, but I think the main thing where there's just absolutely no fix to it. If you are a AV company, whether that's a Tesla, a Waymo, Nebius's AvRide, WeRide, whoever, Pony AI in China or whatever, if you're operating independent of Uber, you ultimately are, you either have way too much supply or you have way too little supply to kind of match to the demand for it in a local area. And so if you don't mind, I'm going to share my screen here to kind of better illustrate this. This is a slide directly from Uber's Q4 of last year. This is a slide they have in there. Can you see this?
Let me figure out how to make you big. Maybe let me remove myself.
Nope. I took over the stream, guys. It's just me in here.
Maybe not. I don't know. I think if I remove myself, then maybe if we'll do it this way, maybe people can see. I mean, I'm not. I would have a producer normally do these things for me, but it's the first, and I'm cheap, and I think he went out last night. So, I got you. Right. Let me add this. Okay, hold on. I need to remove this one, and then add this one. There we go. Now we got it.
Right. So yeah, everybody could hopefully see this. So this is from the Q4 earnings of last year. And so they've essentially taken, this is just a random city, major city in the US. My guess is it's New York, but they don't tell us. But anyways, as you can see, this is throughout the week with the various different hours. For example, here a little bit after midnight on early Tuesday morning, it's like 1 a.m. on a Tuesday morning. This is 0.1 times the baseline demand. So let's just throw some numbers at it. Let's say there's in New York City, there's 1,000 rides per hour that is requested, right? Just arbitrary numbers. Let's just get some stuff on the ground. So that means a little bit after midnight, there's 100 rides being requested in New York City at 1 a.m. on a Tuesday. Then over here, during rush hour on a Thursday, 5 p.m., everybody's trying to get home. There's 1,700 rides being requested. Over here, there's 1,900. Here, 1,200. And then, again, in the early Saturday morning, there's 300 rides per hour being requested. The point is, there's a massive variability in terms of demand for Uber rides, regardless of what part of the world it operates in. There's fluctuations in demand, whether it's rush hour, whether it's a little bit after midnight when everybody's sleeping, whether there's a Taylor Swift concert downtown and everybody's trying to get an Uber there, or vice versa. The Taylor Swift concert just finished up and then everybody's trying to get home. So if you have a fixed supply of autonomous vehicles, which is what a Waymo, an AvRide, doesn't matter. Any AV company operating independent of Uber, they're going to have a fixed supply of, say, for example, just 300 cars. Well, if you only have 300 cars, then you are way oversupplied a little bit after midnight. And then you are way undersupplied when there's demand for 1,700 rides. So the pitch that Uber has, and this is like core to, again, I have like 5 or 6 different arguments why Uber doesn't get disrupted. This is the number one that like nobody has an answer to, is if you're operating independent of Uber, you're either over or underutilized. And the pitch that Uber has to a Waymo, a Tesla, whatever, is if you come onto our network, we kind of will have your cars as a base layer of demand. So say 300, let's just say that's like the minimum number of cars that are required in a city. So we'll have 300 cars that will essentially have 100% utilization all the time that, if they're not charging or getting cleaned. if they're able to have a driver in them, they're going to have a driver in them generating revenues, right? 100% utilized. And then we'll kind of supplement, like we've always done as Uber over the past 15 years with meta heuristic data. What we're going to have is, supplement it with a hybrid network of bringing on drivers when there's increased demand. So if you've noticed with like surge pricing, right? Like this was a point of contention, I think in 2021. There was a lot of outcry for surge pricing. The reason for that was there wasn't enough drivers. So you, the Uber customer, would have to pay a higher price for it, right? So they kind of are able to balance out that supply and demand in any given city. Give extra bonus incentives for drivers to come onto the network, send them notifications. If you've ever seen the Uber map from a driver's perspective, there's like multipliers sometimes. So during lunch hour in a certain neighborhood in New York City, if there's an influx of demand historically for food, then they kind of send notifications to drivers, hey, there's a 1.5 times earnings multiplier if you go to this area between 11 a.m. and 12 p.m. because we anticipate there's going to be increased demand. So they kind of supplement, like a hybrid network of, you have that base layer which maximizes revenue per car, and then we have a hybrid network with human drivers to essentially kind of balance it out, if that makes sense.
Yeah. So this makes sense to me. I guess following tech for as long as I have, I'm not sure that the Googles and the Amazons, that they care. You know what I mean? Like, do they really care that they have cars sitting underutilized?
I think they have to.
When I think in the long term you have to, right? But could you how long can you not care for, is how I would put it. Is how long can Tesla, and in particular Google as well, how long could they not care? I've seen these companies, and this is not applied to ride sharing, but Google in particular is legendary for launching a product and then not caring about charging or making money on it for a very, 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 very long time. That is what, and so it's like scar tissue of that I as being 40, 40, I'm almost 44. That's what I see, is that the Googles could not give a damn about Waymo being fully utilized or any of that, as they just go out and try to get as much share as possible, because they know that, oh, our balance sheet, while Uber, we didn't bring up Uber's is probably really good, really, really good. They understand that if Uber has to start making investments, whether it's in the AVs themselves or in splitting, where instead of taking home, I don't know what their gross margins are, but instead of, let's say it's 50% gross margins, it gets shaved down. Or if they have to go do the physical infrastructure layer themselves, which we saw them kind of tipping their hat to this a little bit, is this, I don't know if it was rumored, looking to acquire this Spot Hero, which is a parking app. I'd like to hear your take on, why do you think Uber is looking to acquire a parking app, which, if people aren't familiar, if you live in a city where parking is not a big deal, if you're going to San Francisco, and yes, if you go to like the San Francisco Giants game or something like that, the parking is obviously legit. But sometimes you go to a city, parking is obviously at a premium. It doesn't matter if there's a baseball game or it's just you're trying to park in front of a doctor's building. You can go to these Spot Hero apps and not just get parking for events, but if I wanted to park next to a restaurant, or if I wanted to park close to a doctor, I have a doctor's visit or something in San Francisco and I don't want to park, down the street or whatever, I can reserve spots using this Spot Hero app. To me, this is an example of the extraordinary leadership that Uber does have. These type of acquisitions, to me, or potential acquisitions, to me, show a lot of confidence.
Mm-hmm.
And a CEO and executive team that is in full control. This doesn't seem like desperation to me. This is looking towards the future where
Yep.
you need to stage autonomous vehicles. My brother and I were talking about this. My brother and I have been talking about this for like 2 years. We were talking about, okay, so there's an event and 20,000 people are going to the event. Right now, there's obviously you come in your own car, you come in a taxi or an Uber, there's a mix. In a couple of years, depending on the city, that mix is going to continue to fully more and shift to these autonomous vehicles. So where the hell are you going to stage these things? You know, and he and I we've looked at parking lots and we've looked into this business where we haven't made any investments here right now, but we feel this is going to be one of the greatest real estate plays of all time because a
Mhm.
parking lot doesn't need shit. You don't need an air conditioner, you don't need a tenant, you don't need anything. You don't even need really permits to do anything other than maybe one permit to have people park there, maybe a tiny insurance policy. So this is if you're going to get into real estate, a parking lot seems to me. And he and I have had a lot of conversation. We have money ready to go on this. We just haven't. It's not there yet. This market's not there yet. But this is showing me that it's getting there. When you have these companies that obviously have executives that are smarter than me, and have billions of dollars, hundreds of billions of dollars on the line, they're seeing that. Oh my God! When you have an event and instead of 5% of the people leaving in an autonomous vehicle, it turns to 10%, 15, 20, 30%. Where the hell are these things going to stage and be ready for that surge?
Mhm.
You're going to need some parking spots for these things. And preferably with probably, if they're electric vehicles, which most of them seem like they are, you're going to need some freaking chargers or something there. And so I think this is what that's kind of a play towards. I think there's other plays here as well. And I think you could probably pair a spot hero with advancements in satellite technology. So you have more advancements in satellite imagery. You can obviously more accurately predict where there is parking and where you're able to move these vehicles. Because as you said, and very eloquently on that chart, there are utilization spikes and peaks with these things. And if say you're Tesla or Waymo or Uber and you got 50,000 of these cars in a fleet and you're trying to maximize use them, being able to shift them around and
Mhm.
stage them and move them because it's obviously physical inventory, um, that becomes a massive logistic. To me, that's maybe the logistic challenge of the entire business is once you are at scale in a city, where you logistically stage, clean, move these vehicles depending on demand, depending on event, depending on traffic flow, depending on if there's a baseball game or a concert and there's a surge of demand all in one concentrated area, you're
Yep.
going to need accurate data on where you're going to be able to stage these freaking cars.
The fleet
Because
management.
I've seen it myself in person in San Francisco. I also saw it in Los Angeles. And this is why when I go to a baseball game, I could take a Waymo, but I always take an Uber black car with the professional driver because that fool is like swerving in and out. I remember I was going to a Clipper game and we were running late, of course. But this dude was like, I mean, it was the traffic into the Clipper game is terrible. And there were Waymos all stretched out trying to get there, and they were just crawling along. And this guy was in there cutting them off. Um, and so there's always going to be a value for Uber. It is always going to have its place. My concern is that there are very well-funded companies, particularly Amazon, Tesla. And again, everybody has their opinion on Tesla, but you can't argue with $41 billion of cash. That is very
Yep.
difficult to argue with. And Elon Musk, when you go through these financials, this is a company, their automobile business is in the shit, and these financials have not deteriorated to the level in which you would have expected. You're still generating positive,
Well,
very
I mean,
thin, but very
Colin,
positive operating margins.
the operating profits are down 70% since 2022. I mean,
I
that's
that is a function of many things, but that is not
entirely
uh
the car business eating shit. Yeah.
that I would say it's entirely the car business broadly, not not just at Tesla. I mean, Tesla had, Elon Musk causes as many problems as he solves them with a company like this. Um, but again, for the entire history of the company, it's not based on today's problems. It's based
Yep.
on tomorrow's solutions. And the deterioration of the financials here, if you had a weaker leader in charge, this company would be worth
Penny.
$8, or that's
Yep.
Uber, but probably $8 on Tesla stock. Instead, it's sitting at 450, which is like a dime away from an all-time high, basically.
Yep.
I mean, this stock, the stock defies gravity. And that's why I personally would not want to compete against stocks that defy gravity. Tesla could do a fundraising and raise, $25 billion at this level if it wanted to. It's not going to, but it could if it needed to. And then obviously we know Google is,
So if I can summarize, your main point of contention is that like Uber is going up against these very, very well capitalized competitors. Somehow, some way, maybe they lose a whole bunch of money, but they're going to be kind of like a thorn in Uber's growth trajectory on this. That's kind of
absolutely. And
yeah.
it's more of a testament to Uber's success than it is about anything else. They are such a dominant company that my concern is the stock chart starts to look like Adobe. That's my concern. That Adobe in 2023 was at the top of the world. I mean, even going back to 2021, it was at the top of the world. Everybody was at home. Everybody was a creator now. Everybody needed fucking Adobe software or whatever. And the stock went from 682 down to 274. And honestly, the business from a financial perspective didn't deteriorate that much.
It's gone up.
Yeah, exactly. Like everything has gone well financially. It is the perception. That's what keeps me out of a stock like Uber. If I was in Uber, I would have a stop loss at very key levels, because perception, I mean, just on the way up, like we see it with Amazon stock. Amazon's a little different now, but for 20 years, Amazon stock went up on perception. Tesla stock for 20 years has gone up on perception. Google stock went down early this year, and this because you bought it. It went down because of perception of AI and whatever. And so that's what scares me a little bit. And I'm willing to, at my age, say, I don't need to go, because it's not like Uber. It's me going up against Tesla. It's my investment dollars going up against Amazon. It's my investment dollars going up against Waymo. I just don't I don't want to do that. I've seen what these companies do to their competitors. In fact, I'm very, very familiar with Amazon. Amazon will invite you into their corporate headquarters and be like, hey,
Yes.
Aria, you've got an amazing product. We would love for you to come to Bellevue, Washington. They'll fly you in, put you on a private jet. Maybe Jeff Bezos, gets on a 30-second call for you. And you're thinking there like, oh, fuck, I've made it. They meet with you and they're like, thank you, Aria. Well, we're going to talk it over and we'll get back to you. And then 6 weeks later, your product is copied on Amazon's website at half the price. That's the culture over at Amazon. And Google's the same way. Tesla's in a slightly different stratosphere. They're more on the innovative side rather than, hey, let's take what Ford and GM have done and copy it. But they'll all figure out what Uber has done and copy it.
Yeah,
and so
but
that's what has
I
me
think
concerned.
so earlier you were talking about Netflix, I think at the start of the stream, and it's just a Disney wrapper. It's a Disney wrapper built on AWS, right? So
Sure.
I think the one thing I was hoping, if I was on stream, I would have been saying at that moment is I think the key thing to note with that is, what does Netflix ultimately own? Because at that point, it didn't have its own content and infrastructure, whatever. It owned the customer. And that was
right.
the key value. And now today it owns the customer, therefore it owns the distribution, so that when it buys a Warner Brothers, it could instantly be like, hey, this $20 subscription, boom, just for you because you're a Netflix subscriber, 50% off. Go ahead.
Right.
Subscribe to HBO,
Sure.
watch your Game of Thrones, right? So I think the underrated component there is the Uber of today, similar to the Google of last year, owns the customer. It has 200 million
Mm,
monthly
mm,
active users. And
mm,
on the flip side of the network, there's 9 million drivers as well. So there's a value to that in terms of the CEO consistently talks about potentially opening up other gig jobs. So like data labeling for LLMs, that's a real business for them right now, where they're getting the drivers to do like 30-minute little, this is a carrot, like data labeling, right? So anyways, the value of the Uber network or the Uber business today is the distribution they own. They own the customers and whatnot. And then more in terms of oh, this is just roadkill because they have well capitalized competitors. Again, you could pick examples of this throughout history on both sides, but we have like success stories where like, why isn't Spotify dead today? Apple with their literal infinite checkbook, why didn't they crush them, right? Or YouTube, for example. YouTube, like music is free on YouTube. Why does the Spotify exist today? So there's slight nuances to those companies that have like that extra level of focus. Where in the case of a Spotify, I personally use it literally every day. I don't know about you, but
mm,
the UI is really nice. The AI algorithm for discovering new music is really nice. When you're making a
mm,
playlist, it recommends 5 songs at the bottom similar to your playlist. So it's these very like tiny
mm,
little nuances with the app that on its own, yeah, like the music discoverability isn't a reason to choose Spotify over an Apple Music, but it's that combined with like the 10, 20 other things that they do really nicely, a little bit 5%, 10% better, that adds it all together and it makes
mm.
that app preferable over a an Apple Music, for example. So that level of focus, I think, is something that could potentially help them out in this case. And then another thing in terms of like, okay, why doesn't, again, like we go back to Apple Music versus Spotify? Why didn't Apple Music just copy everything they did? Um, like I'm not exactly convinced that these big tech companies are willing to just throw everything and anything at it. I think very recently we saw Waymo is raising outside capital. So Google owns about 80% of Waymo. Why wouldn't they just keep funding the operations, right? Even this early on, they're looking towards outside capital. It makes you question where their priorities are in terms of investment. You have this very proven cloud business that you could dump 100 billion of capex into, and very predictably, in my opinion, over the next 5 to 10 years, make massive amounts of ROI on, or this maybe potentially fragmented market, a little bit more unproven, a little bit more risky in terms of AVs. Throw some capex at that as an area of investment. So I don't know. I think that does speak to the priorities of somebody like a Google. I can't speak too much on Tesla because they're, again, as you mentioned, like a little bit earlier on in the curve. That's
Mm.
not as definitive. But Waymo and Google in particular, I think, we're already seeing signs of they're kind of deprioritizing that as an investment area. Yeah.
Yeah, well, I could. Your argument about Netflix was a good one, where they were just simply a wrapper for Disney, and that the chart. It's so funny. The Netflix chart looks exactly like Spotify's. Um, they were a wrapper for Disney. They didn't own anything, but they own the customer. They own the user interface. They own the recommendation engine. I think my only counter to that is once they got into owned content, I can't
Mm-hmm.
watch like Selling Sunset's the only thing I've ever watched on Netflix. I can't watch Selling Sunset on Disney Plus. You know
Mm-hmm.
what I mean? And so is the product that Uber is going to offer, is it so much different than a Waymo or a Tesla to where if I'm a user and I'm sitting in San Francisco and I'm trying to get from point A to point B, or if it's my pizza on the other side of town, and that pizza joint is making the decision, they don't give a shit about Uber or Waymo or anybody. They just wanted that pizza to go from me to the shop, or the shop to me, in the cheapest
Mm-hmm.
price possible. And so when you have a race to the bottom in price, particularly when we're talking about food delivery,
Yep.
or good transport, that gets me a little more concerned about Uber's position because they own less of the stack. Whereas Netflix didn't have to necessarily be the lowest price. They were lower than cable. They were lower than going to the movie. Even today, I think. They're still at that low price. And if Uber wants to play at the low price, then that certainly will impact their financials, their take rate, and all those types of things. And so um, to me, it's uh, uh, Is Uber going to be around in 5 years? Of course, like, hell yeah. And they could be the dominant player in, I mean, still the dominant player in ride sharing and I think more importantly, delivery.
Mm-hmm.
But could the perception of their business not meet reality and it look more like Adobe or pick your company? Could it look like that too? I think there is a risk there. And if it was like, look, if it was AV Ride and it was like fucking, some, second tier company competing against them, I'd be like, screw this, I buy Uber. Because they'll end up outlasting them and they'll go buy them and then they'll integrate it. But when we're
Mm-hmm.
talking about Google and Tesla, and Amazon, and there'll be other ones too. This is just kind of the first. This is kind of the first foray into this.
Mm-hmm.
My guess is with AI, the stuff I've seen from I think it was Rivian recently, it's like like this self-driving stuff will get solved all of a sudden,
Mm-hmm.
and that has me a little concerned, at least of the perception of Uber's business. I don't think fundamentally they fall apart. That's actually pretty rare at this scale to completely fall apart. Like it happens, but it's pretty rare. PayPal's, their business has not completely fundamentally fallen apart. It's
It's
just,
about to, but not
it
yet.
might, yeah, that's true. It might. Um, but the perception of it has changed. You were the exclusive platform on eBay, you had COVID, and then now you have, you know, 10 other competitors
Right.
that are in the space. At one time, they had no competitors or very few or underfunded competitors, and now there's multiples across the squares and the firms and all the SoFis, even maybe potentially.
Just Apple Pay,
Um,
Google Pay being free. I mean,
sure,
every time
sure,
I go
sure.
to checkout, I just click the
Right.
thing. It has my credit card saved. Why would I ever use a PayPal?
Exactly. Exactly.
Yeah.
So I mean, I'm watching Uber very closely. If this is an area where if somebody's watching this and they agree more with you than they agree with me, this is an area where, like, look, if you wanted 100 shares, spotting 5 to 10 of them at this spot.
You're not
Uh,
sharing your
uh,
screen, by the way.
oh,
Yeah.
how do I do? Oh, yeah, hold on. So Uber, where it's at right now, if I wanted, like I said, 100 shares, I'd spot myself 5 to 10 at this level. It's not the
Mhm.
worst level. It's held this level. It's in fact, it's spent days under this level of the uptrend. It spent days under that, and so now here you are. And I mean, clearly it wicked into that area and then bounced back very quickly. Where I would like this one, with a margin of safety, is closer down to this support level down here at the 5860-ish
Wow.
level. That would be more exciting for me. And like some people have the view like, hey, we're going into recession or whatever, and then yeah, this stock will get crushed if that's the
Uh,
reality.
I
um
would I would actually I think Uber's a bit counter cyclical in the sense that it's both like again just based off like surface level you think, oh yeah, if we go into a recession nobody's going to order a $20 burger, which yeah, like makes sense. But if we go into a recession and with recessions usually there's job losses, that's more supply of drivers, at least for now, right? And assuming it's a hybrid network in the future, more supply of drivers, that means it makes ETAs come down, it makes the average cost of rides come down, and so that should balance it to a little bit. I think they're a little bit more insulated to a recession than people give them credit for, because usually the prices of rides and eats comes down in a recession because of the higher supply.
but isn't that offset by how much their take rate is? So if the price of stuff is coming
Take rate
down,
remains the same.
they're so on a $20, they don't pull a percentage, they pull a fixed amount. You
Uh,
see what I'm saying? Like
so-
on a $50 ride, if they take 10%, they're making $5. On a $20 ride, if they're still taking that 10%, they're only taking two.
right. Okay. You're saying, yeah, the total percentage goes down. But the thing is, in that case, it's not the same ride. So like, if there's a driver that's 5 minutes away from you, they might, that ride might cost $15. But if they're, 2 minutes away from you, that ride might cost like $13. So it's, if there's increased supply, those drivers are closer to you. So the ride can be cheaper and be worthwhile to them.
Could offset. So what you're saying is the lower price could offset some demand destruction of
Yeah, and then
weaker
the
labor
average
market, less travel, less willingness to buy
exactly.
the $35
And
pizza that
also the average Uber customer is a little bit more affluent than just the average
sure,
consumer in general. So
sure.
again, I'm not saying in an actual recession, yeah, they're going to get impacted, just like every other company that's exposed to the consumer. I think maybe barring Costco, there isn't really truly a recession-proof business, even them to a certain extent, right? Um,
Yeah,
but I think they're more insulated than somebody would give them credit for.
sure. I mean, yeah, there's the volume profile. This cluster of candle is where I'd want to buy it. So
Mhm.
we're close. I mean, like, look, somebody that is not super patient or is in love with this stock. This is a spot, where you can step in. There's plenty of demand underneath the shares where they're at, and
Yep.
everybody's looking at the same chart and the same data. So they see this demand down here, and they were like, "Ah, I don't need to wait for it to get down there. It'll act as support. So I might as well buy it here just in case we rebound, we go higher." I don't. For the record, I don't think there's going to be some recession. I think it's going to be the opposite. And so yeah. Okay, that's Uber. I think to me, it's one of the most interesting stories in the stock market is what happens with this, with the autonomous vehicles, with Tesla. Tesla, it has to be a bigger chunk of their business. With Google, it's not even a rounding error at this point, but could be very exciting. And obviously, Amazon as well is this is kind of a fun and cute thing that they're doing, but their goal is obviously to replace all their employees and delivery drivers with autonomous vehicles and robots. So that's the end goal with them. And so to me, they're the dark horse of willingness to invest in moving shit around. Because if Amazon can solve that, even at a major loss for a decade, if
Mhm.
they solve that, now all of a sudden they're $500 billion e-commerce business. They add 3 points of margin to their, eventually $1 trillion a year revenue that they generate, which I think they're on track for, which is hard to say.
Yeah, I think
Um,
they're coming up on 700. I mean, they recently passed up Walmart as the highest revenue company in the world. Yeah, 691, I see.
so when we're talking about, I mean, analysts are projecting $1 trillion in revenue on a company at 2029. So if over the next 4 years they can figure out how to shave 2.5 points off of transportation cost by replacing these people, I say that harshly and coldly, but this is an investing show. I don't think anybody cares. If you're an Amazon delivery driver, we love you absolutely. Um, so yeah, the whatever the earning estimates for 2029, 1396, it's probably a couple dollars higher if you can shave off you know, a couple points. So that's the company, this is the dark horse company of them all that won't give a crap about investing here, because if they can solve this on the Las Vegas Strip, then they probably can solve it, delivering grandma some toilet paper in the mail. Um, that's that to me is will be interesting.
Yeah,
This to me is the darkest horse of them all, is this company, because they have the highest incentive. Tesla has high incentive. Google has some incentive. The highest incentive is Amazon. If they can solve autonomy, delivery,
hmm
movement of something, whether it's a person or a box, if they can solve that or come pretty close to solving it, at least in like their key markets, 30%, 40% of where they operate, then you're looking at a company that should be worth exponentially more than it is today.
yeah, for sure. We have a couple comments here as well, if you want to
Yeah,
get to them about
yeah.
Uber and stuff.
Let's see. How would you compare Uber and Lyft?
They are worlds apart. I have this one chart up on Twitter where it's like, just off memory here again. I think in terms of revenue, Uber is give or take 8 times larger, or it might be gross bookings. Come to think of it, but okay. Anyways, it's like 8 times larger, and it's growing faster. So Uber's revenues are growing at about 18, 19% or so. Lyft is in the low teens, if I recall correctly. This is just a classic case of the biggest scale player in the industry wins most of the bread. This is it's like a winner takes most style of market. Now, again, AVs could, in theory, kind of shake that up, but Lyft doesn't even cross me as a potential investment opportunity, and that's purely from the moat not being as strong. When you have more scale, ETAs are lower, the service is overall better and more convenient and this and that and everything. There's more mind share with it, and yeah, it could be a decent value play. They trade at like 10 times cash flow. So, I mean, you could in theory buy that. And I think a more promising thing is buying Lyft as an acquisition target. I don't know why an Amazon, maybe regulatory piece, but I don't know why an Amazon doesn't buy Lyft, why a Tesla doesn't buy Lyft or something like that, right? So that's something that could potentially be interesting. But again, we've seen over the past handful of years, regulation wise, it's been difficult to acquire businesses. Yeah.
Yes, and what I would say, I use an athletic analogy in these situations is Lyft is destined to win silver at best,
Mm.
and Uber is, the
Potential at platinum.
Yeah, they're the gold medal winner, and they're the U.S. women's basketball team, that I don't think has ever won anything other than gold. They're the American swimmer, Michael Phelps or whatever. They're destined to win the gold medal, and that's what they're going to do. And Uber will win silver, which means if you buy Lyft at the right price, just like AMD. AMD is destined to win silver, actually more bronze in the AI race. If you buy a bronze medalist at the right price, yeah, you can make money, but boy, you better time that. Your timing, in my opinion, if you're going to buy bronze and silver medal stocks, your timing has to be freaking amazing. If you're going to buy gold medal winners, especially if you have a long-term focus, it doesn't matter really, because you can pull up a long-term chart of Apple is clearly gold medal winning stock. Did it really
Netflix.
matter, anywhere along that chart? That goes back to 1981. I was not, or 82. I was born in 1982, and it didn't matter at any time in my lifetime when you bought Apple. You could have bought it at any time. So if you're buying gold medal stocks, it doesn't matter. If you're buying silver, bronze, upstart, small cap stocks, especially, boy, your timing better be freaking sensational. Better
Yeah,
be great.
that's good, great analogy. Honestly, I think you're a little bit more uh, understanding of these stocks, but I think Marvell as well. Marvell versus a Broadcom, right?
Oh
Marvell
my
hasn't
God.
done too
Uh,
well, and that's another bronze medalist.
yeah. I mean, I for my opinion, like computer engineer. I mean, this chart looks fantastic. I mean, there's nothing wrong with that right there. That looks fantastic. But if you read a lot of the geeky stuff that I read, I mean, these people just talk crap on Marvell all the time, and they have these moments where to me, it's like it makes you nervous. Obviously, though, if you time Marvell right, it's a great investment. Whereas if you closed your eyes and bought Broadcom anytime over the past, decade and a half, it
Hmm.
didn't really matter. Didn't really matter.
Yeah,
Uh, what
it's a great
stops
analogy.
Tesla or Google going out and creating their own ride sharing platform or buying a competitor? Nothing right now. I would say there's, first of all, Waymo has their own platform. It depends on what city you're in, but if you're in San Francisco, you have the Waymo app and it works very well. The Tesla app I have downloaded, I have not been in San Francisco to try it to see if it works. It looks like it functionally works. Tesla software is actually pretty good. In general, the Tesla app tends to work. The software inside the car is actually pretty good too. So they're a competent software company, and clearly have the resources as well. Somebody buying Lyft, to me, you don't buy Lyft until you are close to scale, right? Like why, like I don't think, like Waymo, I could see any of these companies buying Lyft, particularly like an Amazon. In fact, I think it's been rumored in the past.
Hmm.
But you don't do it until you're ready to flip the lights on, right? Whether it's you have 500,000 of these autonomous vehicles or however many you think you need in the key cities here, just speaking in the United States, you only need to have these things in San Francisco, LA, New York, Miami, Chicago, and that's about it. You could actually probably have a big business just in Los Angeles and San Francisco and Cal. You could actually probably have a public company that trades pretty solidly just in California, because now you're not dealing with weather as much. These things in Chicago and New York, it's tough. When it snows, it's gonna be tough. I mean,
Yeah.
like just ask an Uber driver. It's probably tough to operate an Uber in the pouring snow in New York City. Miami's a market, but uh, when you have that, when you have your business at scale, it's like, okay, how do we pour gasoline on this? You go buy Lyft. And that's when that might happen, or you just assume you're going to squeeze the silver medalist's neck and they are going to die. That is also happens more often than it doesn't. So
Yep.
in a lot of ways, you don't even need to buy them, because if you're Google and Tesla, your software making abilities and resources in that area exceed, particularly on Google, exceed Lyft by orders of magnitude. So
Yeah.
that's what I would have to say about that.
I would if I could just quickly add to that on the
Yes.
back in terms of actually making the app, literally nothing. I think I could probably even
Yeah.
figure out vibe coding an
Yes.
app in the next couple
Sure.
days. Again, the value goes back to what they own the customer. So it's these
Mhm.
other things that they own, and like the back end. I very briefly, mentioned it earlier in the stream, but Uber has 15 years of meta heuristic data, and
Right.
Google also has that, but Google has that for maps in terms of getting someone to a certain destination. Uber has that data in terms of actually like seeing, if we offer this ride at this price to this person at this time, will they take it? And then in the ride, if we offer them an upsell, or like right as they're about to press it, if we offer them an upsell to go to an Uber Black, for example, this is
Mhm.
data you can't buy, you can't simulate it.
Right.
It's meta heuristic. It needs to happen. It's kind of like weather. It needs to happen
Yeah.
for you to actually be able to gain that. And then there's a degree of randomness that, again, you probably can't really simulate it unless you put like NVIDIA GPUs the size of the United States to kind of
Mhm.
do it, right? So this is data you can't buy, and this is stuff that, again, until you actually go out there and you run the operations for a long enough time, you won't be able to have like super accurate, very sharp matching of supply and demand down to like the various different neighborhoods of these major cities, and so on and so forth. I believe earlier in the year we had NVIDIA partnered up with, because NVIDIA is trying to get into the autonomous self-driving space as well, but they partnered up with Uber strictly for their data, and they're
Mhm.
the three of them and Microsoft are backing Nebius's Avride, right? So again, kind of like we don't have full details on like what they're really doing, but speaks to their incentives and their intentions in terms of where the direction of the industry is going. Yeah.
I tell you what, the lift chart, you get to pull back to like $15 on this one. It'd be I'd send it there because you've got support. I wouldn't want to see it get under 11, so you're risking 4 to the downside to
Mhm.
make 13. That's not bad. Um, any thoughts on industrial stocks like Caterpillar, Deere, or UNP? So Caterpillar's really interesting. Caterpillar, we think of them as just these freaking tractors and stuff, but this stock chart is looking like the gold chart. This stock chart is unbelievable, and it makes a lot of sense when you go through the financials. They're building these like they've got these like things, these turbines, if you will, that are going into the data centers. So they're not just supplying the tractors and the earth moving equipment. They've actually got physical infrastructure that is actually powering the data center. And so Caterpillar to me is interesting. Would I want to buy it out here at the all-time highs? Not really, but you get any kind of weakness in this one, particularly back to the previous highs of 402. I know that seems like a long ways away, but man, this stock has gotten really overextended. Pullbacks in that one for sure. Deer and the other one, I don't know as much. I just read something on Caterpillar, so that's why I know more about it. The rest of them, I don't think that's right.
Yeah.
Oh, right here. Maybe this one. I mean that chart. Whoa. I mean that looks fine to me right here. And again, I'm just speaking chart wise. Fundamentally, I'm sure it's fine. It's $100 billion company. It could be worse. Um, yeah, this is a spot where if you want to buy it, yeah.
I think
And
the
I don't.
US ticker's DE, by the way, if you want to just
Oh,
maybe look at that
DE.
one.
Okay, D.
Yeah.
Okay, let's see if that. Let's see. I mean, similar chart. So
Yeah.
it's good. This looks good to me. I think I had these bars over here. I think it was yeah, this was Trump administration number one. I was like looking at like ooh, what stocks ripped during Trump one. This one went up 4 or 5 months in a row. Obviously, we're a little deeper into that now. And then obviously pandemic, had a had a nice impact on this one as well. Um,
Vertical.
yeah, so this one looks fine to me. Technically, fundamentally, I'm sure it's fine. The last, what was the other one? UNP. Oh,
This one,
Union Pacific. What
revenue
do you know
growth
about this
issues.
one?
Yeah, like
Okay.
revenue is
Whew.
like 1%, 2%.
Sure.
It's
Yeah.
not the best. A very wide boat business because I mean, what are you
Right.
gonna do? Go lay more tracks that have been there for 150 years?
Right.
But I don't love the growth on this one. I know Canadian Pacific is another comp in the industry. They've connected
Yeah.
for the first time ever. They've connected Canada to Mexico. It of course trades at a more premium valuation, but it also grows faster and has that unique differentiation versus the other. I think there's 7 Class 1 railroads, so it has that unique differentiation where it literally connects Canada to Mexico. So
Sure.
yeah.
What I would say broadly, if you're going to use, not everybody does this, but I like to let the price. It's like if you're going to buy a house, what would you let, what decisions would make you buy the house? Certainly the neighborhood, the condition of the house, blah blah blah. Like obviously if you're going to buy a house, those things matter. But if the house was perfect and it was in a great neighborhood, but it was 5 times overpriced, you wouldn't buy it, unless you were just
Mhm.
absolutely insane. Whereas if all the conditions of the house were absolutely perfect and it was on sale, like you would like do everything you can to buy the house. And with a stock like this that has just been in such a well-defined uptrend since that's hard to say. 1970s, you have a 50-year uptrend in this stock. Um, it's trading at a level that is above where I start to like these things in the middle of these channels. That's where, I mean, we looked at Uber earlier. That's where Uber is. So I wait until you get, and Uber's, I clearly don't have a 60 or 70-year uptrend, but um it could be beginning one. It's at the middle of
Hopefully.
of a well-defined uptrend. And so that's what I look for. And Union Pacific's still a little higher than that, is what I would say. Real estate in 2026. Um, I mean, I would say so interest rates coming down would be good. Home Depot, every time I look at their conference calls, they talk about all this pent-up demand in terms of refinancing. So everybody has all this, not everybody, but anybody that owns a home that has had it for any length of time has equity in their house, but most people have borrowed at 3.5%, 4%, somewhere in that range, maybe even a little lower than that. And so in order to tap that equity in a HELOC or a refinance where you cash out, you don't necessarily want to go for, there are people though that will go from a 3% mortgage to like a 6% mortgage on a refi. So they can put $200,000 in their bank account. There's going to be plenty of people that will do that. I don't think there's enough people yet to move the needle from a real estate standpoint. Here's what I would say. This is really super anecdotal evidence here about the real estate market. And you do see this when you not necessarily looking at real estate companies, but I was looking at Constellation Brands, which has Corona and some other brands. What is having a massive impact on real estate in California in particular, and other parts of the United States is the deportations, if you will, for lack of a more eloquent term. I live in an area where it's easily 50-60% Hispanic. Like I walk around, I'm like the only white guy. So uh and I am seeing for rent signs in we need, because like look, where I live, it's more agriculture. So you go to the apartment complexes, for the past 10-15 years, the streets would be lined with cars. There'd be these, relatively modest apartments where 3 or 4 people would be living in them. That's what they could afford. I'm not criticizing anybody. I'm just saying these are the facts on the ground. Okay. So facts of reality. This is the fact of life. If you're an agriculture worker here, either legally or illegally or whatever, or in limbo, the fact is you tended to rent lower income apartments and you tended to live there with maybe your family or 2 or 3 other people. Those apartments are coming up for rent. I'm seeing specials. I'm seeing stuff I have not seen in a while. There's a lot more for sale signs. If you listen to Constellation Brands conference call, they're telling you sales of Corona are in the absolute tank. And that is having a big impact on certain markets. Now, it's not having an impact on Montana's real estate market, but Montana's real estate market is pretty small. Maybe even not even New York City's market, but maybe a little bit. But in the West, Arizona, Texas, it's having a huge impact. Now, what does this mean from investment standpoint? Well, it means more turnover of real estate. It means there's less demand, particularly at the low end. That means a driving down of rental rates. We're already seeing this a little bit in the CPI, but it's a huge lagging thing. As you move into next year, I'd be shocked if CPI doesn't keep ticking down, maybe not across the board, but on the what they call owner's equivalent rent. So we don't need to get into how it's calculated and how they calculate all that. But my guess is rent over the next year, 2 years in portions of the United States are going to continue to go lower. That is going to impact resale prices of homes. That's going to impact real estate investment. All of that is probably good for real estate. All of that's probably decent for real estate. It looks like to me too, the Home Depot chart has broken out of a longer term trend, but as long as it holds the new flattening of uptrend, it's not bad. Lows, again, we're looking at like the home improvement stocks, but flattening of trend is what I'm seeing here. You could look at the home builders. KB, I think, is one of them. If my internet still works.
RH might be
no.
another one. Maybe not.
Is this Restoration Hardware? Yeah, I was looking at this one the other day. There was clear
RHI,
support.
maybe? No, I don't know.
The small cap that I love is QXO. They're trying to roll up the they're trying to roll up the home building material business. So now we're in a derivative of home building. Very interesting company. I announced it on a newsletter. I'll take credit for this. I announced this on a newsletter, and this thing pumped to. This is all like non-split adjusted. This thing pumped and came back down to earth. But I know people personally that made six figures on this one, so needless to say, they are very affectionate towards me in the comment sections every once in a while. This one, short uptrend, short history with this company. Can't really look back in the history of it. It's really this green. This is the home builder pump. It was like a $9 stock, and then it pumped to like 118, $200. So that's my pump basically. Now it came all the way back down to earth, and I bought it down here. QXO is interesting. You're seeing movement in roofing and stuff like that. I would say, based on the read from like Home Depot and stuff like this, it's like a troughing of the industry. And if you get lower interest rates, you are golden. ServiceNow, I love ServiceNow. Love the CEO.
Fundamentals are unbelievable on that company. I just don't understand the business, to be honest with you.
Of course, I bought it and I got stopped out. So I lost money on this one this year. But everybody lost money on it, so I don't feel that bad. This is an area where you do want it to hold. ServiceNow creates, in my opinion, it's one of the quintessential software layers of AI. And they have, one thing I talk a lot about is leadership, and they have one of the best CEOs in all of software. Bill McDermott, or Doug McDermott, is incredible. Guy's incredible. I love the guy. You listen to a conference call of him, and if you're like feeling a little sluggish, just listen to the first 30 minutes of that call, and you're like, God damn, I need to get out and make some sales. So he's great. I think software has a rebound next year. I sort of selling coming in on this one at least. I'm waiting for a breakout above. I think with software, you're going to have a move higher. People are going to buy the stuff that wasn't working, and you're going to have a back test, and that's the time to move. You see it a little bit with CRM. CRM broke, not really hard, broke trend though, and now you're trying to hold this level and then move higher. I think software has a great year because I think the market completely misunderstands AI, and they think, oh, ChatGPT is going to be every software to everything. It's like, you got to be kidding me. That'd be like saying AWS, when it was created in 2009, was going to eliminate all of software. And there was going to be no Netflix and there's going to be no Uber because AWS was somehow going to solve all of that shit. Um, and look, maybe some people were saying that back then. Large language models is just a new software application layer of the cloud. Um, and the price is plummeting to use it. And so I love ServiceNow, but I would wait for a little bit of a push higher, make sure there's demand. Beating down dividends. You don't really do a lot of dividend stocks, do you?
Me,
Is there a
no,
dividend on
I
this
think
list?
just
Maybe
ASML. I
ASML.
think
Yeah, they
that's
got a
it.
little
Yeah,
bit. We didn't really talk about them.
I guess
I am
you go.
max long bullish
Yeah,
ASML.
no, same thing. Such a great
Almost
business.
as bullish to me, almost as bullish as Avgo, but my view of Avgo is I recommended it at split adjusted 83. So, clearly the affection runs deep there. ASML is what I would say about ASML, just quickly, is there's always going to be these rumors that China has some system in the works, or China has a white paper, or China has some kind of demonstration of ASML. It's 99.9999% of the time it's shit. It's not true. They do not have what ASML has. No company has this. Ask anybody with any, and look, I'm not of competence to understand what ASML's, how those machines. Now I've spent days of my life researching these machines, so I understand them at a third or fourth grade level from people that I respect who would tell me that, oh my God, China's EUV is coming. They're like, no, it's not even close. So this is as durable as a moat as you will have. And my guess is, if you're my age, Aria's age, maybe not, my age, you are likely being able to hold this into retirement um, with the moat still intact.
Yeah.
So no
If I
worries
can add,
there.
by the way, it's not a simple technology question either. So even if China in theory can make at the same nanometer length that the ASML light could do it, which by the way in of itself is impossible because ASML vertically owns some of its
Right.
suppliers, the most critical suppliers. I think Carl Zeiss and a couple other ones. So that in of itself, they don't even have that. But even in some magical world, if they're able to actually replicate the machine, there's a question of throughput and there's a question of yield as well. Which is, if you're selling to TSMC, they want to know, okay, great, you can print at the same nanometers, fantastic. How many chips per hour can you make? Oh, 100. Phenomenal. ASML machine does 2,000 for us.
Right.
Okay. You know what? You can print 2,000 just like the ASML machine. What's the yield? How many of those
Right.
come out with no defects? Oh, 1 in 10 chips that come out has defects. Well, the ASML machine is 99% good.
Right.
Only one
Right.
of those chips comes out with a defect. So it's a
Right.
multifaceted question of, first of all, make the technology that you can't because they own the vertically integrated suppliers. And again, you literally cannot make the same technology as them. So you have to do that. Then after you do that, you got to match the yield and you got to match the throughput. It's just not happening. Simple as
Yeah.
that.
Right. In terms of what he was asking, Procter and Gamble, this technically is rolling over. This reminds me a little bit of Costco. I clearly look at the Costco stock chart all the time. This one has rolled over. This is an area where it is either going to continue to roll over or somehow magically find footing and move higher. I say magically when you make this rollover formation, the probabilities say that you are going to head lower. So these stocks get it more exciting the lower they go. The Proctors, CRX, I can't remember Clorox right off the top of my head. CLX, yeah. Yeah, my guess is all these stocks are going to have the same formation. This one doesn't. This one, look, I mean, this was support right here. Whoo, you just broke that. That is lookout below time on Clorox. So, and Colgate, I don't think I've ever looked at. I just bought some toothpaste. It's like a powder. It's like really weird. Or it's like, yeah, it's not even like a paste. It's like a powder. This one looks actually, I mean, like that's pretty good. Like
I think
look,
Pepsi's chart.
dividends. Oh yeah, Pepsi. Yeah, I was looking at Pepsi recently too. More fundamentally too. So you broke trend with that. That's rolled over. Most of them are making this kind of rollover formation. Pepsi's did a like kind of like depending on how you put the line in there, did a back test and is trying to hold this level. But these stocks get a little more interesting, but I think they're a sign of what 2026 is going to be. These stocks would be pumping with gold if everybody thought, oh my God, we got to hunker down and the economy is going to go to shit and blah, blah, blah. Like these stocks would be pumping. Costco would not be rolling over. Colgate would not be rolling over if we thought, oh my God, the world's about to end, whatever. I don't think they'd be rolling over like this. Um,
Mm.
these look like to me they want to head lower, and I like them there. I prefer dividend growth rather than just pure yield. A great dividend growth company is Visa. So your percentage yield now it depends on where you're at, right? If you're 60, 70 years old, you've got to go for the flat out yield. You need that 4.5, 5%, whatever it is. If you're younger, I would I would favor more dividend growth. So what is the growth of the dividend over the long term? That has massive payouts. One stock we haven't talked about really is Nike. Yeah, Nike's in the shit. But this was the very first stock that I bought when I was 17 years old. Or yeah, I was 17-ish. Yeah, I think it was 1997, so I was actually 15. I was 15, 16 years old. I buy Nike stock. And I remember it's
Jesus
like I
Christ.
remember it was like $7. Okay. Has the shares gone down? On paper, has the value of the investment gone down? I bought $1,000 back in it was like 1997. Those shares have split. They've dividend. I've reinvested every penny of the dividends. Uh, Now I would have cashed out, but this was in an account that my dad has control over, and we've never, even after all this time, we've never taken him off of the full custody of the account. So, and that has been a blessing because I've seen the compounding effect of growing dividends, and Nike has been one of the best compounders of dividends. And it's not an account I look at a lot, but the dividend payout of these shares is extraordinary after 30 years of compounding dividend reinvestment. And then every year you're getting a dividend growth. I'm assuming when I bought Nike shares, either didn't pay a dividend or it maybe started paying one after that. And the face value of the yield was like 1%, 2%.
Yeah.
The dividend payout of my Nike shares is double digits. And so, yeah, you continue to hold this shit even as it goes down because you would, first of all, you'd have to pay a massive tax bill on the realized position of the gains, but also you would lose that dividend stream. And so that's why it's important this stock in particular holds its dividend. You will have another 60% decline in this one if it does not do that.
Yep.
And yeah, you will retest this area down at 40 and 30, which is another position. I have a second position in Nike that I acquired during a similar time frame. I remember it was like this time Under Armour was coming up and, you know, same, everybody's talking about On and Hoka and these brands that like white people wear and they're not popular. Um, I remember buying Nike during this stretch. Its best days are over, blah, blah, blah. And, it'll come back. So
There's only one Nike.
there's only one Nike. And I bought some shoes from them the other day. You got to get a pair of these if you like spending millions of freaking dollars on shoes. Um, these Vomero premium shoes. And I don't do this. I don't care about a pair of shoes. Like I have nice shoes, I have nice clothes, whatever. It is something I care about. These Romero premium shoes are so comfortable.
Mm.
I have this pair right here. These shoes are I'm telling you right now to everybody watching this, these shoes are so comfortable that when you wear them, you literally can't wear anything else. So that is the
Mm.
only problem with these shoes I mean, first of all, they're like $300 after fees. 230 retail, but they're very hard to get at retail right now because these things just came out. These shoes are so freaking comfortable that I have one pair of these and I don't wear them all that much because I want to get a second pair because I don't want to wear these out. I've got CES next week and I'm going to be walking like 10, 15 miles a day. And I want these to be, I don't want the air bubbles to pop or whatever.
Mhm.
Um, Unbelievable comfort. And so for me, for Nike, so to tie it back to the investment standpoint, is they didn't re-release a Michael Jordan shoe. They didn't slap a Michael Jordan logo. They developed this shoe from the ground up with technology that they had. And this is the most life-changing shoe that I've ever bought. Like I wear these and I'm like, oh my, like I wear them around my house because I've got like hard floors or whatever. And sometimes like I'm walking back and forth, like I'm listening to something and I like to walk or whatever, get my steps in. And I put these on because it's so much more comfortable. So when I see this with Nike, it's like, okay, they're on the right track. We didn't see this under John Donahoe, whatever the loser CEO was before. He would just slap a Michael Jordan logo on something or come out with the Jordan 5s in a slightly different color, and then you would put them up for sale. And that's what they did. They didn't innovate anything. They didn't come out with really any new shoes. This is like a new shoe that they've made where I'm like, oh my God, they have some new colors coming out in a week or two. And I'm going to try to get them at the two, like it sucks paying $300 for a pair of shoes. It's not something I like to do. Um, but these are worth it. These are, if you, I mean, like $300 shoes, like, trust me, I understand is not for everybody. But if you're comfortable paying that much for a pair of shoes, 100% worth it. My man, John Blake, Happy New Year, my man. It's great to see you. Hopefully you're doing well.
Colin, did you want to maybe look at wrapping this up in a little bit?
Let's wrap it up. I know I'm the kind of guy that you start getting me going. I'll just keep it going
I'm
forever.
happy to keep going. I don't mind. I
No,
don't.
no, no, no. I don't want to do that. My brother and I would do these live streams. We would do it on baseball cards of all things, and we would go like 8 or 9 hours. So that is not my intention. Believe me, my intention is to wrap this up. But we did get a super chat. Thanks for you both having amazing content. Hopefully you both have safe and blessed New Year's. Likewise. What are your thoughts on a company like ServiceNow? We did cover. I think you asked us, so I appreciate you throwing the $4 in. ServiceNow has great CEO, great leadership, great product. Okay, for whatever reason, the stock market believes that ChatGPT, everybody's going to be vibe coding software. That's not going to be the case. It's going to be like we're entering the phase of cloud 2.0, where the Netflixes and the Ubers, when they were early stage companies, those companies are about to come. And even the existing players here, ServiceNow is like a platform. It's not like Salesforce. Salesforce is a little bit of a platform, but it's more rigid. ServiceNow, like if you're 7-Eleven and your Slurpee machine breaks and you need to create an application to like bring in a service tech and manage that billing and all that stuff, like there's clearly no off-the-shelf software that does that. That's what ServiceNow does, is they build application software on top of their platform. And with AI, clearly it's amazing. I love MasterCard. Chart looks great. Advice to buy silver. I wouldn't touch silver right now. Time to buy silver was when it's low. Buy silver when everybody thinks it's worthless. Sell it
I
when
love what you
everybody
have
thinks
there.
same with Bitcoin. When everybody thinks Bitcoin's gonna go to $5 million, that's when you sell it. When they think it's worthless and zero, that's when you buy it.
Yep.
That'd be my advice on these kind of like binary commodity type things.
Yep.
I understand silver has huge use case, but I'm trying to sell. I bought coins at $15. Believe me, I was buying this stuff when it was super low. I was buying it during the coming out of the Great Recession and all that other stuff. Trying to figure out somebody to buy my silver coins. Happy New Year, guys. We'll wrap it up. I don't want to keep Aria too long. Thank you for coming on today's show. I'm glad we
Absolutely.
finally were able to connect in real life and real real. I think we've connected on the internet and stuff. And we're still connecting on the internet, but at least it's face to face. So it's good to finally see you in the flesh, if you will. If you come to California,
Absolutely.
let me know. If you're ever in the Bay Area in particular, that's the closest spot for me, but you would never have me saying no to go to Southern California either. But if you
Likewise
ever,
for you if you end up in Toronto somehow.
I have never been outside of the United States, but Toronto would be one place
Wow.
where I would entertain the possibility. Here's what I tell people is that people around the world, I know people have opinions on California, but the bottom line is people around the world pay lots of money to come to California. So, I rarely want to pay money to leave California. It is a beautiful
Mm,
place. I don't always agree with all the politics and all the other stuff, but what I will say about California is if you work hard and you have money, the politics and all the other stuff, you don't even notice it. It doesn't affect you at all. But you got to work hard. You got to every year you got to make more money. You got to save some money and you got to make more money and you're going to pay more money in taxes. But it's a great place to be. And if you don't want to work hard, you got to go move to Austin, Texas, or some place like that. Is what I tell people. Um,
love
yeah.
it.
Well, thank
You'd,
you,
you'd get
Aria, for
along
coming
well.
in.
You'd get along well with my dad. He's a big fan of California. He consistently
Oh,
talks
good.
about, oh, we should move there, this and that. I don't think
You
it's gonna
should.
ever happen, but
You should.
but
You should
yeah.
come out here. I'm trying to buy a house further to the I'm a ways from the ocean. Everybody's trying to move out of California and move away from the ocean. I'm like, fuck that. I want to do the opposite. I'm trying to buy a house over on the ocean. My bank account has not even nearly enough zeros to do that yet, but maybe one day we'll get there. Probably when my kids are out of the house, which is still a ways away. Aria, thanks for coming on. I will hang in here. I will answer a couple more questions,
Okay.
but I don't
All
want to
right.
keep
Well,
you any
thank you
longer. I
so much.
appreciate you being.
Again, I mentioned
Thank
it.
you.
You have truly been one of the first YouTubers I found on just investing in general. I've been watching you for literally years. Never missed a Fang stock recap show. Got a
Well,
streak going on that.
that's
So
amazing.
I
I appreciate
sincerely
that.
appreciate the opportunity. Yeah,
Of
man.
course.
Thank you very much. All right.
Well,
Thank you.
you're welcome anytime, and I appreciate it, and I enjoy your content as well. And anybody watching, I think would as well. Thanks for coming on.
Thanks. Bye.
Thank you. That was Aria, and again, you can find him on X. Let me close this out and figure out what his handle is. It is Quality Invest 5. And then on YouTube, I believe you can search quality investing with Aria and you'll be able to find his channel. He does like these deeper dives on all the stocks that we talked about, the Metas, the Adobes, the Ubers. He actively shares like his portfolio and his mix and all that type of stuff. So if you're somebody that anybody, we didn't talk about Zeta. That next time we have him on, we'll talk about that company. He's talked about it a little bit on X, and so it's a company that I've just pulled up, but I haven't gone into the conference calls or anything like that. And so that's a company that I definitely want to look at. We'll answer some more questions here. It is New Year's. I appreciate everybody tuning in. Hope you don't mind one questions on. I'm assuming that's Barrick Gold, Oshkosh, Conagra, Hormel, Campbell's. Love your dividend stocks. What I would say is with your dividend stocks, you hold them with the Campbell's. Yeah, CPAB. Um, yeah, you're just holding these stocks. You try to ignore the price performance because price performance can be, I guess, can be a little rough. But you're obviously buying it for that dividend yield, and that with a company like Campbell's, you're buying it for the overall yield. 5.6% is obviously relatively high, even with where interest rates are. With a Visa, you're looking at the face value of the yield is under 1%. But when you look at the dividend growth of this company, it is extraordinary. Like the dividend, the CAGR on the dividend growth is like in the mid-teens. So if you bought this one like when it IPO'd or even like maybe 10 years ago, you have turned a 42-cent dividend into now 240. And so two different strategies, uh, depending on which way you want to go. If you're going for the just the face value of yield, just focus on that. But I think there is real value in the compounder of dividend growth if you have, let's say, I don't think there's any fixed number of years, 10, 15, even like in my case, like I'm 43, but I'm probably not touching my retirement stocks. My hope is I never touch my portfolio, honestly. I hope I just have fun researching stocks and I buy them, and then one day I kick the bucket and my kids are like, screw it. I don't want Nike stock. I want to sell it and go buy something. Um, and maybe they'll be in a position in their life where getting $1 million or however much I can end up saving up, it it allows them to maybe spend more time with their family or take a year off work or change their path. Maybe they were on the career path working at the corporate level and then dad dies and they get a couple $1,000,000 and they can go do something. Or maybe they haven't bought a house yet or whatever. That's my hope. And dividends are a great way to do that, honestly. We did discuss Adobe earlier. I think the general consensus is Adobe's fundamentals are really good. The perception around Adobe is not great. The perception around Adobe's fundamentals don't match what they are on paper. I don't think I have them up anymore. Oh, they're right here. Oh, that's Google's. Adobe's fundamentals are good. The business is growing. They're buying back the stock. To me, I'm looking for an area of reversal. If it's going to happen, it should happen very quickly with Adobe. Like if you want to buy Adobe, this is, I don't want to say it's the moment, but the door is open is how I would put it. And if I were to give you like a specific like dollar value, like let's say I wanted to buy 100 shares of Adobe at the level that it's at right now, I'd buy like 5 shares or whatever. And this is assuming you have free, with that in air quotes, free trading on your broker. If you have to pay per trade, you obviously have to size these things a little bit differently. But if I wanted 100 shares, I'd buy 5 just as kind of a starter, kind of watch list type of thing. Technically, you're waiting for a breakout. And this is if you pay attention to the technicals. You're looking for a push higher on this one at some point, and then I would buy the back test. Now, second scenario is Adobe stock craps out here and makes a new lower low. I would not want to see shares get below 260, but I would comfortably buy it anywhere above that level. But I would not want to see Adobe get meaningfully below 260 because now you're in, I mean, like I don't know where support is after that. There is legitimate support like in the low 200s, but who knows what happens there. Perception wise, Adobe, it's not good, but fundamentally the stock's not, it's actually not that bad. Highest upside, Meta, Amazon, or Netflix. I would say technically Meta has higher upside. Meta to me, in fact, we're 34 days from earnings. If you get a monster rally at the beginning of the year, Meta will make a new high. So you go from 660 to 850, call it, or 800, somewhere in that range. That's the next technical stop where if this pattern continues to play out, that's where you're going. So that's $200 in upside. I think there's I'm not putting my trade on like this or betting on this, if you will. But it wouldn't surprise me. You could do that in 34 days because do you really want to be on the other end of Meta having a bad quarter on the back half of the Q4? And one company that serves as a proxy for it is Shopify. Because if you have a Shopify shop, you get all your traffic from Meta, basically. That's a broad generalization, but it's largely true. This stock is at an all-time high. And so investors are telling you that, and then anecdotally, if you go look at see what Shopify execs are saying behind the scenes and in kind of the the corners of the internet, if you will, they're signaling that they had a great quarter. And so my guess is Meta is going to have an absolutely fantastic quarter. And it'll be about painting the picture about AI and stuff like that. So technically Meta looks absolutely fantastic fundamentally as well. I'm very bullish on their business because they have distribution. Amazon, technically the upside is not as high, at least in the shorter term. Longer term, though, I don't know if there's a stock with more upside than Amazon. You have $1 trillion of revenue projected by analysts going into 2029. I mean, $1 trillion. If you can start and again, this is an investing show. We say this with all due respect for delivery drivers and warehouse workers. But if you can replace a good percentage of those people with robots and autonomous vehicles, then $1 trillion, there's a lot of operating income and profits generated from that. Netflix, technically it's broken. On a monthly view, change it to a daily view. You'll see technically you've rolled over, you've found support. If I were to buy Netflix, I don't want to get it below here. The problem now, I was in Netflix, I got stopped out. I can't remember where I got stopped out. It was like an 8 or 9% loss because I just didn't want to see this. The Warner Brothers acquisition is now, it's anybody's guess how the market will either reward or punish this company for that going forward. I don't know. What I don't like about Netflix is the executives within the past 180 days had said, we are builders and not acquirers. Now, they always would frame it and say, well, we would look at anything. I don't like executives that say that. Like, literally, you can go to Netflix's conference call and pull out the quote of an executive saying, we're builders, not acquirers. When they get asked questions like, hey, would you buy this? Would you buy this? They would answer the question like that. And then literally 6 months later, you make the biggest acquisition in the company's history. I hate executives that do that. Just tell me the fucking truth is what I would say. And so I don't like executives that do that. Just don't beat around the bush. If you would buy Warner Brothers, you don't have to say explicitly, obviously on a conference call, you have to qualify it. I realize these guys, other than like Elon Musk and Jensen Huang and the guys that are in the stratosphere from a CEO perspective, they don't beat around the bush and they say like off the cuff Elon Musk in particular. But I don't like executives that don't, especially of a company this size. Just like, be honest. QXO is run by a man named Bradley Jacobs. Brad Jacobs wrote a book, How to Make $1 Billion or something. How to Make a Few Billion Dollars. This book is absolutely worth reading. Brad Jacobs founded Waste Management, and by saying founded, he may have like worked his way into these companies by acquiring them. So take that maybe not as a fluid statement. Waste Management, United Rentals. There was another company, yeah, XPO. XPO was a stock that I bought before and this is how I came across Brad Jacobs. I bought XPO stock in 2008. It was after the great financial crisis, October and November, split adjusted for $4.12, but I think my cost basis was 33 cents. There was reverse splits after that. I bought the stock then. Brad Jacobs buys the company, transforms it into the quote unquote leading trucking and like one of the leading truck brokerages. I sold my shares for, I remember it was like right around this time, right in March of 2015. I sold them for $45. And the house I am sitting in today that I'm recording this video on was paid by XPO stock. And so when Brad Jacobs, because he was running XPO and they did a spin out and he was doing other stuff. When he announced that he was going to do QXO, which is a roll up of the building material business, so roofing supplies, plywood, I guess, stuff like that. When he said he was going to buy or roll that up in this QXO, which was called Silver Sun Technologies or something when he did it, you just buy it. You just buy the shares. And I actually, at the time, I couldn't buy them because I was working for a company. I recommended them. And so I recommended them. And so you can see the pump. I was working for another company and I put out a newsletter and a YouTube video, and it was sent to 500,000 people. And I think the title of the video and the article that was sent out was the best penny stock of 2024. And it delivered. It went from this is all split adjusted. I think it was like $8 to over, like, it was like a lot. I had people emailing me like, Colin, I just made, a life-changing amount of money. And I want to take full credit because Brad Jacobs' reputation preceded him. And so as the news was getting out of QXO, I just happened to be one of the first people that talked about it because I followed Brad Jacobs on LinkedIn. I follow him, and so when he announced this, in fact, he teased it and I was like, oh shit, he's got a new company. I even texted my brother because my brother made a ton of money on XPO as well. When he teased it, there it was. I didn't experience this pump because legally I could not own the shares, but I bought it on the, like, look, the air gets let out of the balloon on these things. And so my cost basis on this was, I don't know, maybe $12, $13, somewhere in there. And I'm just riding this one like I did XPO. They want to grow this into a $50 billion materials business. It's currently at $13 billion. They have some cash. They have a business that they've acquired that generates revenue and I believe operating profits, or it's thinly profitable. And it's a roll up strategy. It's not for everybody. These stocks are not for everybody. Um, and the building material business is not for everybody. Home Depot and Lowe's have made some acquisitions here, but Home Depot and Lowe's stock has actually gotten punished since the acquisition. So my view is that the Home Depot and Lowe's executives are like, well, that didn't work. At least from a stock performance perspective, I think they were good acquisitions. So I think they'll have less competition there and they'll be able to buy there. It's a fragmented business, just like tool rental. Tool rental still is a fragmented business, but United Rentals is one of the players, and same with waste management. So the trash business used to be all these independent, it still is somewhat of that, but waste management rolled up all the cities and private trash companies into one company. And so QXO is a play to roll up. There's like hundreds of in just one region of California, let alone through the United States, there are hundreds of building suppliers. And QXO is a play to roll that all up. And that's the play. So that's the thesis. And when you have, and this kind of plays back to something that we talked about, kind of touched on a little bit over the live stream, is I factor in leadership big time to the investments that I invest in. If you have great leadership, people ask me all the time, hey, Colin, how do you find good stocks? What stock should I invest in? I'm like, forget the stock. Just find a guy or a girl, that's freaking amazing. So who's amazing? Jensen Huang, obviously. Elon Musk. Say what you want about him. This guy is amazing from a leadership standpoint. Okay. Obviously I said Jensen Huang. Before that, Steve Jobs. And Brad Jacobs would be right up there at the top of my list of top end executives that have proven themselves over many, many decades of many, many businesses. He is top tier. So when you find a top tier guy, the Starbucks guy, that guy's top tier. Starting to show up a little bit in the price of Starbucks, top tier. Somebody asked about ServiceNow, top tier CEO right here. Top tier. Yeah, I would say even Mark Benioff, CRM. Little bit different style, but definitely top tier. When Disney has had a top tier CEO, it's good. When they've had shit CEOs, it's been bad. And I've called for those ones to get fired. Across the board, Nike's had bad CEOs and they've had good CEOs. When they've had good CEOs, the stock's gone up. When they've had bad CEOs, it's gone down. Uber's got an amazing CEO, top 10 CEO probably in mega cap or large cap stocks for sure. I'd put him in that category. He's fantastic. So AT&T has had terrible CEOs and has good ones. Apple has a decent CEO right now. AMD, unbelievably good CEO. Lisa Su is amazing. So find good leaders, and in some ways it simplifies things. You find these CEOs that are really good. And what is a good CEO? In my opinion, it's one that drives its team to produce. And I think the quintessential example of that is Tesla. And people criticize Elon Musk all the time because he says all these different things that don't ever come true. The only reason why he's saying it is because he's trying to set the expectation level and the goals over at Tesla to be very, very high. And most executives can't do that. They can't say something on a conference call that then in 6 months or 12 months doesn't end up being true. Elon Musk can do it all the time because he has such a large ownership of the company and his identity is more or less tied with the brand. That is what you want to invest in. And if I pulled up a stock chart of Tesla, again, fundamentally, Tesla is oftentimes a mess. But there's the stock chart. And that's leadership right there. Okay. No, it's not valuation. It's not always the product. It's not profit margin. It's nothing. It's leadership. That's what leadership can get you right there. And I experienced that firsthand with Brad Jacobs. XPO was a fledgling trucking company when I bought it. In fact, I probably shouldn't have bought it. And then a leader took over and he bought me a house. So I am forever, ever, ever grateful to Brad Jacobs. And if I ever saw him, I would have trouble holding back tears how grateful I am of him and what he's done for me and my family. His work at XPO changed my life. And when you do that, I will buy whatever stock you get into. Buy range for TSM. TSM. Yeah. I mean, anywhere. I'd like it back at this orange line or somewhere, you know. I'd like it back at 222. I don't know if you'll get it. Anywhere with TSM. I mean, I I mean, if you want to take a more speculative swing, here it is. Who's got a shot at a foundry business that's not gonna be as big as TSM, but could be a chunk of it? This is the only company with that ability. American company. Okay, so I would take a shot at Intel. Oh my gosh, here's one. I think I'm paying these guys. I profited $75,000 on QXO and still own 10,000 shares with a cost base of 13.25. Thank you. Reese, thank you. You don't have to thank me, thank you. At 75,000, that's a good one. You come to Northern California, maybe we can go out to dinner. I think you'll be paying. Because I have a similar cost basis. But yeah, the QXO call was, I don't want to say it was lucky. It was just when you have these years and years at this point, like I've kind of like, in my third decade of investing, you just pick up a lot of stuff. And I would have never bought a building material roll-up company, but because I bought the trucking equivalent of it, and then studied Brad Jacobs. And I've bought United Rentals before. In fact, that was one of the lead, like on our premium service, we recommended United Rentals earlier this year, and we closed it out for pretty solid gain. This one's actually getting close to a rebuy. You could actually buy United Rentals. You could buy it right now, but this is actually looking pretty good technically. Dividend growth here as well on United Rentals. But hey, $75,000 profit. I love it. Let's go out to dinner. I went into Fiserv and got crushed. Yeah. You got to be careful with these. I mean, you guys don't need me to tell you this, but you want to be a little careful with these like high flyers, and it's great on the way up. With this one, there were some areas, and this is how you protect yourself a little bit. Because trust me, I get in these situations too. I got in with Oracle. Oracle's a great example, guys. Got into Oracle early this year in April or something at a pretty low price, and the thing went parabolic. And I picked a level. I can't remember exactly where it was on here, but I picked a level where I was, as it was going up, I was like, okay, I'm gonna get out at a certain point. And it crossed over that. Nebulous was another example. Love the company fundamentally. Like I said, met with management. Everything's fine with Nebulous. But when you go parabolic like this, what I like to do is just put up a stop loss. Now you don't have to sell the whole thing, like the previous guest had, was like, like he had QXO and he realized 75 on it, and then he kept a few shares, as kind of a longer term thing. With Fiserv, there was a couple areas. There was an area at 156, didn't want to get under 56. I know this in hindsight is easy to say, but technically, even when we're looking at that chart right there, so that's the chart with Fiserv, and it's pulled back from the highs. That's what we know about the stock. That's what we know. I would say, okay, there's a cluster of highs or a cluster of action here. I don't want to get through this, okay? Because if you get through this, now you're down to this cluster. And so I would not want to see this one to get below 157. And then the big one was right here. In fact, we'll put a box around it. You did not want to get through this. Once it got through this, then you can see like it is. I mean, I have no idea. Now you're down here. As crazy as that to say. Not saying that's going to happen, but your next cluster is down here at 10 or 12. That's scary. To me, that also lines up with what we were talking about with Adobe. And this is where, God, why can't I? AD, oh, it's ADBE. This is where it gets a little scary with stocks like this. When you're old like me and you got the scar tissues, um, I do not want to see Adobe get below 260. Yeah, there is some support at that level, but it'd be between 2 and 230, 240. So that's a little scary for me. You do not want to get past these levels. The other ways you can look at these, if you can't like pick them out naturally, there's a fixed range volume profile and it shows you the areas of consolidation with Adobe. Once you broke through this cluster, you come down to this cluster. Once you break through this cluster, you come down to here. If you break through here, I mean, God only knows where the next one is. I mean, it is all the way down here. With Adobe, it's down below 100. So that's scary. Yeah, there's a little meat on the bone at 150, but scary. So just be a little careful when the stock goes parabolic. I mean, it's a blessing when the stock goes parabolic, but just hit your stops. And a great example for me more recently was Oracle. I love Oracle. Like literally like 2 weeks before we sold Oracle, I was at Oracle World and they like comped me. They like let me come for free or whatever. Um, and they were great to me. But you had to sell. Yeah, you had to sell. You had to do it. Yeah, maybe with the tight stop. That's the other thing. That's the other good point. So the comment is a Fiserv looks good with a tight stop. Sure, if you want to buy these big red candles, because that's basically what you got here. Okay, awesome. You can buy the big red candle. Not something I would do personally, but if you want to do it, fine. You don't want to get below the previous lows, which on Fiserv is at 58. Because if you find footing here, and look, big red candles, what is it? United Health. United Health put up some big red candles. Okay. There was a level where you finally found support and then you reversed. The other one that a lot of younger people are into is this Duolingo. Big red candle. Okay, cool. Like if you want to buy Duo, that fine. I personally wouldn't buy this stock. But I wouldn't want to see it get below 165. So yeah, you could buy it 175, lose 10 if you're wrong. And look at this thing gets back on track, you probably make 100. So those are the setups that I like. Just be comfortable selling a stock for a loss. It's something that is hard early on, but look at stock buying like a business. So one of the businesses that I used to run, I don't run anymore, but I used to sell stuff on Amazon. And I would get pallets of stuff. And on that pallet, things would get damaged, things would get returned, things wouldn't sell, the price would drop, and I would have to sell some of the goods that there was just a certain percentage that would get lost in transit, that would get damaged, that would get returned, that wouldn't sell for the full price. So I'd have to mark them down and sell them on sale. In the grand scheme of things, though, it was a good business. It was a profitable business, but portions of your inventory are going to sell for a loss. And I would just look at that as across your entire portfolio. Occasionally, you're going to have to sell some inventory of your portfolio for a loss. You just want to make it manageable. Okay. If 50% of my portfolio was in Duolingo, which is like insane, but like let's assume that like look, and if you bought this one at 70 and it went to 175, it might be a big portion of your wealth. You just want to be a little more aggressive, shaving that off. You don't have to sell all your Duolingo shares, but shaving some of that off. If it's, if 10 shares of Target is nothing to you, which would be like $1,000, if you don't care about $1,000, okay, cool, buy it here. And if Target goes bankrupt, whatever, you lost 1,000. But if it's meaningful amount of money to you, and I would say in particular, if you're younger or you're just managing your portfolio for one of the first times or really getting into it or whatever, developing those positive habits are important. We're in 2026. People want to lose weight. They want to, get in shape. They want to eat healthier. They want to quit smoking or drinking or whatever, which is all exactly what you should be thinking about probably this time of year. Same thing on the portfolio side. Trim those losses a little sooner. Rebalance. Don't be scared to rebalance on a stock that's gone up for you. Nobody's ever had a bad day taking a profit. I brought up the chart of XPO. If I still had the shares of XPO, like I on paper, I don't know what that would be worth. Probably would exceed the value of the home that I'm in today. Yeah, the home I've bought has gone up a lot in 10 years, but my guess is these shares have also gone up a lot too. Okay, maybe actually not as much as a home, but let's assume that it did. That's that's the price you pay. and the memories I've created in this house, and the memories, more importantly, my kids have created in this house, are worth way more than any stock. Len, I don't know anything about Len. I don't think. Oh, Lennar. Ooh, ugly chart, at least in the short term. Lennar, yeah, you can buy it here. Technically, again, I'm speaking technically. I don't know anything fundamentally. I haven't read the conference call. Don't know the executive. So just saying that. Technically, yeah, it can be a buy, and then a pretty tight stop. You wouldn't want to get it much lower. Like I could see buying this at 102 and having to stop at like 92. So you're risking 10 to the downside to find footing here and get back up into the 190s. So it's actually a pretty good setup from that sense. Trade desk, ooh. Fundamentally, Amazon is killing these guys. And you can see based on my you have 5-year support on trade desk. You do not want to get lower than this. I also don't like this company heading into earnings 48 days from now. Who knows? I mean, you've had these wild swings on earnings. And so that's what has me concerned about trade desk. What also has me concerned is Amazon has gone into their territory and their business, and Amazon is not joking around. That also ties into what we talked about earlier in the show when we talked about Uber and competition and stuff like that. It's scary to me when Amazon is coming for you because they are ruthless and they do not care. and this chart is an example of that. If I bought trade desk here, I would have stop losses dollars underneath where I bought it for sure. And there may be a better way to play that with options. I can't speak with any authority on options trading, but there could be, if you're buying something at 37, you're setting a stop at 34. It could be that there's like a better way to play that with options. HLTR. I don't got it here. It'll rise in 2026. Well, I hope so. If you got some, I hope. I like having a mix of both the dividend growth and dividend yield. Yeah, penny wise, I agree. I have a mix of both as well. I tend to shift more towards dividend growth, but I've got like what is the one everybody owns? Realty Income. Now I know they continue to raise their dividend yield every month, but it's a very small amount. The dividend growth over here is not wildly attractive, but this is one, the REITs and stuff like that, where you don't get a lot of growth, but you get consistency. Yeah, I have I have a stock like this. I've owned this stock for a very long time. I think this is one of the oldest positions in my portfolio. So I love that. I like growth and yield in my dividend stocks. Any ones you like. I own Nike and Visa too. Dividend growth off the top of my head. Starbucks is risky now. Starbucks was one, but it's a little risky. McDonald's is probably past its growth phase, but it's not bad. Dark horse dividend growth is Meta and Google. I wouldn't necessarily buy Google at these levels, but wait for a pullback on Google. I would buy Google at a lower price. Meta at this price, technically, you could have dividend growth here that lasts a very long time. So dark horse dividend growth, I would say, is Meta. Doesn't get talked about a lot. Yes, John is correct here in that Nike executives are buying stocks like crazy. And I was wondering, like, I listened to the conference call, and over on the paid side, I did a full, it was maybe a 15-20 minute video on Nike talking about it. But what's interesting is I did the video and the report on the earnings before the executives started buying. You had Tim Cook come in and buy $3 million worth of shares. Tim Cook is on the board of Nike. And I believe a Nike executive, or at least I knew Mark Parker, I believe, was also maybe in turn aboard on Apple. The two companies do share some of those ties, if you will. And I understand to Tim Cook's like paper net wealth on Forbes or Bloomberg or whatever is a lot of money, but $3 million open market, if you will, buy of a company. That's a lot. That's a lot. And then Elliott Hill bought $1 million worth. And I know like $1 million, whatever. Elliott Hill started out as an intern at Nike. This represents a huge amount of his liquid net worth. I almost guarantee you $1 million to Elliott Hill liquid is a lot of money for him. Now, $1 million to Tim Cook, even $3 million to Tim Cook, liquid net worth. I'm talking about, like, if I were to ask Tim Cook to write me a check, the largest check that he could write, I would assume Tim Cook could write me a 10 or $20 million check. Okay. And that sounds crazy, but just understand that billionaires on paper are on paper billionaires. They don't, almost 100% of the time, don't have any of that money in the bank. Elon Musk might be the best example. If you hear about like the house he lives in and stuff like that. Now, I'm not saying he's broke, but to have a billionaire write you a large check could be I'm the same way. I tell people like I couldn't write you a $10,000 check right now. Are you crazy? Like, I invest all my money. I'm 100% invested in stock. Now give me a week and I can write you a $10,000 check. I can get you $10,000 cash. Okay. But I couldn't write you a $10,000 check right now that could clear right now. I don't have $10,000 sitting in a bank account. Are you kidding me? There's all these great opportunities in the stock market. Why would I keep $10,000 in a bank account? And so Elliott Hill's similar. $1 million is a lot to him. Nike is badass. Yeah. After wearing Brooks, Ghost, and Hoka, never buying Nike again. I don't know. I'm telling you, Vomero Premium. Guys, buy yourself one of the, I mean, if $300 sneakers are your thing, unbelievable comfort. And what I would say about Brooks and Hoka and On is Nike doesn't compete with them. I know that sounds really strange, but the people that wear Brooks, and this is not me disparaging the commenter or anybody that wears these brands. Okay. The person that wears Hoka and On, these people are buying what they think is cool. They're buying the brand that is trendy. They'll wear Lululemon leggings 5 years ago. Now they're wearing Aloe. Here's how I'll describe Nike. I'm from the hood in Stockton, California. In fact, I drove by I was in Stockton a week or so ago. Stockton happens to be one of the most dangerous places in the United States and probably the world. There are some nice parts of Stockton. I'm not going to ask like I, grew up in poverty or whatever. But it's not that nice of a place. Here's how I would describe Nike. This is how you know you have staying power as a brand. How can I say this without completely offending people? Here's what I'll say is white people will wear whatever they think is cool at the time. Sometimes it's Nike, sometimes it's Reebok, sometimes it's Under Armour. Trust me, 10 years ago, Under Armour was the shit. I know this because I wrote articles about Under Armour. Let's see. Somewhere on here, I can search for tickers and I can go back a long ways. We're going back quite a ways here. Going back to Under Armour. Under Armour. The race Under Armour will lose. Notice, folks, here, the price at publication. And so I'm qualifying myself a little bit here with fashion. And I'm here to tell you that I understand fashion stocks. That doesn't mean I necessarily predict them accurately all the time, but I'm telling you, I have a keen eye and understanding of fashion. Okay. I know that sounds weird for me to say, but I do understand what's going on in the fashion world. And I've had for a very long time. This article was published in 2016. At the time, Under Armour stock was $39 a share, almost at an all-time high. The news and the tenor and the belief of Under Armour at the time was that it was going to overtake Nike. Very similar to how people feel about Hoka, feel about On, feel about, insert your shoe brand, or the same way about Aloe over Lululemon or whatever. Under Armour was the hottest brand in apparel at the time I wrote this in 2016. And I wrote an article saying that was all full of shit. The kids that don't make cool brands do not live in Westwood. All you need to do is go to shopping malls. This was when shopping malls were a little more populated in California. where you see less affluent people, what they are wearing. That is what has staying power and what is cool. Do not look at brands that affluent people, especially investors. If investors are saying that they're wearing a brand, it is not going to be cool and it's not going to be around for very much longer. Period. End of story. Every investor thought everybody was wearing Under Armour because at their affluent gym, they were wearing Under Armour. At their affluent soccer meets, people were wearing Under Armour. That is not who makes brands cool. How you find out if a brand is cool is you need to go to the ghetto in Stockton and see what brand those guys are wearing. I will promise you, I will turn max negative short Nike is if I go back to the hood in Stockton and instead of wearing Jordans, the homie is wearing On and Hoka. I can confidently say after making several trips to Stockton, including one every week, the homies, and I say this all very affectionately, it's very difficult for people. In 2016, it was a little bit different. I understand, and today we live in this more political and this environment where talking about race and gender and socioeconomics is a little harder for people. You have to, if you are not comfortable with that, do not invest in fashion. You have to look at black and white and Hispanic and male and female and transgender, and you have to look at it very logically. Okay. And the most logically way I can say this is if the homies in Stockton are wearing Nikes, Nike is going to be fine because the white person in Palo Alto and the rich affluent person in Palo Alto, guess what brand they were wearing 10 years ago? They were wearing Under Armour. They don't wear Under Armour anymore. They're wearing On or Hoka or one of Aloe or whatever. Okay. In 10 years, that person will be wearing with whatever they think is cool. The homie in Stockton will be wearing a pair of Jordans. He will not switch brands. He will be wearing that. His kids will wear that. That is Nike's core customer. So when people are like, Nike went woke, well, what do you think the core customer over at Nike is? Okay. It's not the affluent white person. It's not the affluent Asian. It's not the affluent, Indian or whatever. And again, I'm talking about race here. A lot of people can't do that. If you can't do that, you can't invest in fashion, particularly high fashion, particularly athletic fashion. If you're comfortable in doing that and you can look through all that and you can comfortably say, this is what black people are wearing, this is what white people are wearing, this is what rich white people are wearing, this is what poor white people are wearing, this is what poor white people want to wear, this is what poor black people want to wear. If you can clearly identify that, you can make a lot of money in fashion. If you can't, because here's Under Armour stock over the past, since I published this article, it's down 87% and the S&P 500 is up 215%. You have to look at fashion logically. And if you are affluent and wealthy, what you wear doesn't matter at all to Nike. It's what the guy that is spending all his money on a check, what he is buying. And I'm telling you right now, I go to the poorest parts of Stockton. I was in the poorest parts of Stockton a week ago. In the poorest parts of Stockton, the homies are still got the Jordans on. That's all you need to know. TSM probably lost everybody. It was like, he's talking about race. You have to. TSM, I've heard very bullish things about TSM. I know it's up 127% over the past year. I would have a stop somewhere, but wouldn't surprise me if that one keeps going up. Let's just say that. Yeah. Oh, Broadcom. Yeah, that's a good one. EOG. Ticker's that. Oh, a resource kind of mining company, maybe. Yeah. Broadcom, that's a good one. That's a little sleeper. Thank you. Short-term trend on Avgo. This is Broadcom. Short-term trend looks fine. It pulled back to a 200-day moving average. We'll have to switch this to a daily view. Broadcom pulled back to a 200-day moving average. Oh, I don't have it on here. Let me slap it on there. Not to the dollar, but it pulled back to 200-day and bounced. I mean, it's got a lot of consolidation to get through. If you look at like the short-term like demand profile of Broadcom just over the past, I mean, it's tough. This we'll call it 350 level. There's plenty of the most demand, in fact, for shares at that level. so it's difficult to drop below it, but it's also difficult to churn through that. You have earnings in 56 days. I don't know anybody that's going to want to be on the short side. Arbitrage opportunity with Polymarket and options. I would love to be able to figure that out. In fact, um, if anybody out there is truly, you don't have to be printing money on Polymarket, but if you have strategies that are, they don't have to, like, trust me, things don't work 100% of the time. But if you have high probability of success on Polymarket, you can email me and reach out to me, and you can do it on Twitter, you can do it anywhere. We could do some business together. Polymarket and the prediction markets are very interesting to me, but I don't have the bandwidth nor the expertise to speak confidently on it. But I do see anecdotally there's huge opportunity there, and if you know what you're doing, and like if you quit your job and all you do is try to figure out how to make money on Polymarket, my guess is you probably could figure out a way to do that. That's right. Stocks in my portfolio right now: Broadcom, Nvidia, Visa, Amazon, Ritza Networks, Apple. I mean, the Mag 7, obviously. Let's just say that. Outside of that, I mean, if you don't have Broadcom in there, that's a big one. Some stuff looks interesting to me. But I would say that's the mega caps. There's some small cap stuff in too. But I would say if you looked at 80% of my portfolio, it's about what you'd expect. It's a lot of Mag 7 stuff. Heavily concentrated though in Amazon, Google, Nvidia, Broadcom, Meta. Meta has more recently has really expanded for me. I have a big position in Meta right now. I don't even want to say what percentage of my net worth is in Meta right now. But part of it is short term momentum, bounce. The other part is fundamental as well. Yeah, I mean, Alex Karp and Palantir has done a fantastic job. I just found a stock I think is close to that on the paid side. Not Palantir like, but I think has. I hate to compare anything to Palantir because this is extraordinary. What they've been able to accomplish. Duolingo, I'm not. I mean, this is in no man's land. If I were to buy Duolingo, which I wouldn't, I'd have a stop about $10 lower than where it's at today. So buy at 175, I'd have a stop at call it 165-ish. Maybe a little lower than that because there's support there. But this is an ugly, 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 ugly chart in the short term. Longer term is still okay, but this is the beginning of an epic downtrend, is what that looks like. IREN, I published a lot of research about IREN on which is a crypto miner turned cloud company. Not super bullish on these companies. There's if you were early in IREN, then now is the time to get in. The easy money in this stock is over. Now it's pulling back to the 200-day moving average, back testing top of trend. It's not the worst spot technically. It would shock me if you don't find support here, but that is an ugly, ugly set of candles that it's put up since what I believe this is the top, I think, in these companies. The data center business is not great. The data center business, especially second, third tier data center company. I don't think it's great. I'd rather be at the software application layer now. A regulated cannabis, I'll be honest with you, I don't know. I may or may not have been a user of cannabis in my early days. I can confidently say now I am dead sober. I do not drink, I don't smoke, I actually eat a lot healthier now too. So I've really and my energy level is off the charts, and everything has improved without it. But I have nothing against the industry or the product or anything like that, and have plenty of friends. Like, I'm from Stockton, believe me, all the homies still rolling up. But I don't know anything about the business. It's a tough business, I would say, probably for sure. I signed up for premium. Thank you so much. I appreciate that. Is there a video that does an overview of your service? I tell you what, let me reach out. You should be able to see the email on the back end. Send me an email with the questions you have. But what I'll also do is, I think you've probably seen, I've been doing question and answer. Hold on one second. I'm going to plug in my computer. I think you've probably seen, what you've probably seen is I've done some Q&A, so you can ask me a question anytime. This is something that needs to get a little bit better, if you will, for lack of a better term. The service actually grew way faster than we thought. And so it's been a challenge, if you will, to put those finishing touches, I think, on that. Like I'm so focused on the research and making sure the stocks are good and worrying about them and being nervous about them and trying to know everything we possibly can about all the recommendations I'm in charge of and doing all the research and believe me, I stay up and this is not a complaint. I love doing this. I was up late last night just reading different types of stuff. It's taken away from like the like there should be a good FAQ and all this stuff. So 2026, that's my goal to do that. From slowdown to a recession in 2026, maybe. I as weird as this sounds, I'm not seeing it. I'm not seeing it. I'm not seeing it yet. And look, recessions kind of come out of nowhere. And it's not to say we might have some large dips, but inflation is overstated by the Fed, and I don't see evidence of it reversing. I think you actually have disinflation in some, not across the board, but in some goods next year, which will obviously have a downward impact on rates. And now it doesn't mean interest rates going down doesn't mean stocks automatically go up, but it sure as heck does impact things. Thank you. So you've been a subscriber since April. Thank you. Pays for itself. Thank you. What's your opinion on percent allocation is too much for one stock? So first of all, thanks for being a subscriber. I really appreciate yourself. And if you're in since April, that's great. I really, really appreciate that. And believe me, every single day I wake up resetting the expectations, being like, I got to deliver for you guys today. Like it doesn't matter what's happened in the past. I try to reset it and every single day get better. And certainly I'm never perfect, but always working for that. So I appreciate that. So here's the deal. Is like Broadcom is maybe a good example, or maybe even Tesla, depending on when you bought it. Broadcom could like you could buy Broadcom and maybe you were aggressive when you bought it. Let's say you made like a 5% allocation of Broadcom when it was like $80 or $100 or whatever. And it's triple. So now it's gone from like 5% of your portfolio maybe to maybe way more. Maybe it's 20, 30%. I will let these hover at those levels if I have visibility into the business several years from now. So with Broadcom, I have that. Now let's assume the opposite, maybe like it's a Salesforce or something, or this is Salesforce. So let's assume I bought Salesforce and I got lucky and I bought this a long time ago and it was like, $70 and it just rallied super hard and it got up to 300 and it was a huge percent of my portfolio. But I didn't really have a lot of visibility out for Salesforce. Yes, there's software, recurring revenue, whatever, but competition moat and all that type of stuff is a little more cloudy with a company like that. With Broadcom, just using them as an example, the visibility we have for this company is so clear. Now, it's not crystal clear, but in comparison to the broader market, right, where it's very foggy past a quarter for almost every company, right? Some companies, there's some visibility, especially software companies, recurring revenue, high moat businesses. You have visibility out 2 quarters, 3 quarters, maybe 4 quarters. With Broadcom, it is as clear as you get. You also have dominant market position with their product. They are supply constrained based on how much TSM can deliver for them. Also, how fast the data centers can get stood up. So there's some limitations there. But I have been very comfortable letting this one run into a very large position. I have ran this one down. This one in April went from what is that? It went from it was at 249 and it went to 137. This thing went down 34%, or excuse me, 45% in like 3 months. I didn't care. I bought more. uh, because of the visibility, because of the would I do that with all my stocks? Is the vast majority of my portfolio like that? Absolutely not. So I would say it's stock specific, and it's how confident you are of your visibility of the earnings and the growth. And the other intangible is leadership. And Hawk Tam is is a guy that I love investing money with. Just like Brad Jacobs. He's right up there with Brad Jacobs. I love investing in Hawk Tam because this guy is as cheap as anybody. Now, would I want to work at Broadcom? Heck no. I'd rather go work at Square or Block or one of these companies where there's no pressure and you get all these perks and you get massages and you could work from home and all this other stuff. No, I wouldn't want to work at Broadcom. But do I want to invest with them? Heck yeah. They're taking out the coffee machines. They're not letting people take breaks. Yeah, of course. Okay. And again, I'm looking at this super rigidly from an investor standpoint. From a human level, clearly, you think about these things, but from a pure investment standpoint, Hawk Tan's amazing. The other thing I think what's going to happen with Broadcom is they're going to have a great year. They're going to continue to delever, which is just kind of a fancy term to paying down debt. Okay, because they took out a lot of debt to buy VMware, among other software companies that they bought and build manufacturing facilities. They're going to be able to whittle that down, and you are going during the Hawk Tan era, which I believe, at least from a contractual standpoint, he's getting kind of old. I think you've got a couple more years. He's going to make another acquisition with all of this cash flow that they've generated, and there's no one more that I want to do that than Hawk Tan. To use an example with CRM has been almost like has been terrible integrating businesses into them. Now it's worked out stock performance wise, but they've paid too much. They haven't always integrated very well. Broadcom's not the case. They bought VMware, cut a bunch of costs, expanded margins. They jacked up the price to customers. I mean, it's been fantastic. So now that's not to say the stock can't go down 45%, but when Broadcom was going down 45%, I didn't care. I bought more. So that's how I feel about that. I don't know if I really answered your question, but really it's the confidence level of future revenue. And that's leadership, that is moat, that is those things. And sector. HPY. Happy Creek Minerals don't know. Whoa. HPY. I mean, 20 cents. I mean, you are you're on your own here. It looks great. It's breaking out. You want to break above this 26-cent level. This is a little small for me, but technically you have resistance here. So I would not want it to get rejected here because you will probably come back and retest areas down here at 6 cents, 10 cents. Obviously, when you're talking about, I don't know if you wrote the right ticker, but penny stocks for me are you are trading this thing, you are getting in and out. There is no fundamental argument, at least right now, on a 20-cent stock. It is all pure technicals. And technically, there's something here. I mean, wow. I mean, yeah, you have broken out of a downtrend, at least temporarily. This looks fine for me technically, but boy, oh boy, keep a short leash on these things. If you buy it at 20 cents, like have the stop at 16 cents or something, like risk 15, 20% to the downside, to the upside that you come back and retest these areas of it. Like you double your money. Like that's the kind of risk reward you want on these things. I'm risking 20% where I might lose 20%, but I might make 100%. That's 5-1. That's what you're looking for there. MDB, Mondo, DB. I love this business model. Love this business model. It's a little sneaky. Technically it's a mixed picture, lower highs, but it's not really confirmed. Um, short history on the technical, so you can't really play too much into that. This is so if you're here from the beginning, it's been a while, but the software application layer, the one where we were talking about with like Manus and Meta, the backbone of not all of it, but the backbone of a lot of what like Manus is doing, and companies like Manus is what I should say, is MongoDB like companies. So I love this fundamentally. I don't know enough about MongoDB though. So I'd have to look into it. Technically, it looks fine. And what I would say is I don't want it to get below 130. I know that sounds like a mile away, right? But we're talking about, $34 billion company. It's pretty big. So I definitely don't want to get below 130. I mean, I understand that goes without saying, but that's the clear cliff level of the stock. Higher level, 250-ish. But this one looks poised for a breakout. 200-day moving average is turning. Oh, you should probably switch this to a daily view. I mean, it's going to paint the same story. But look at your 200-day. It is turned positive. I mean, this looks great. You got highs up here. This looks great to me. Looks great. And I think the market is finally correctly analyzing what is happening. Is that the next generation of Netflix type businesses are coming. They're going to build an application layer on top of a large language model. The application is not going to own anything. They're not going to own the data center. They're not going to own the chips. They're not going to own anything. But they're going to create billions and billions of dollars of revenue and wealth. Microsoft, I love Microsoft. It's not the biggest allocation for me right now, but this is an area where if you love Microsoft, you're sitting at the 200-day moving average. And look, over the history of Microsoft, if you bought it towards the 200-day moving average, you're fine. Yeah, every once in a while it breaks through, but this is fine. Earnings are in 34 days. I would just, my rule is I don't buy stocks 30 days ahead of time. So I've been heavy buying stocks over the past 3 weeks, because I don't want to buy them into earnings. Just because these things are going to move, right? They're going to set up. And those of you that watch the Fang Stock Recap show know a very familiar pattern with these stocks. And maybe that one's not the best example, but Meta is probably a better example. Is Meta heading into earnings? And they have the earnings down here with the stock. But like back here in 2024, where'd we set up? At the top. Where'd we set up here? Kind of at the top. Where'd we set up here? Closer to the bottom of the channel. Where'd we set up here? Kind of in the middle, but here we are almost perfectly heading into earnings. What did Wall Street do? They bidded up Meta stock towards the top of a range. Then earnings hits, and then sometimes you have surprises. Here's Meta heading into earnings. Where did it set up? It's set up at the bottom of the range. Okay. But what did we have? We had April tariffs and disaster. Okay. And then where did it set up in the earnings after that? Wall Street, 1 quarter before, set up Meta literally at its 52-week low. And then over the next 3 months, it bid the stock up all the way to its 52-week high to set the stock up heading into earnings at a 52-week high. So you have to ask yourself as an investor, does Wall Street really want to set up Meta's earnings, which are 34 days from now? Do they really want to set it up at the bottom? Now, it might end up working out that way. The stock market drifts and does nothing in January, then it's just going to set up at the bottom, and I'll be fine with that. But the other thing that is, in my opinion, a good probability is that Wall Street doesn't want to set the stock up down here. They want to set it up closer to the top. They want to capture the gain, because what Wall Street wants to do is capture the gains that are going to happen in earnings. And everybody knows that Meta's earnings are going to be great. The wild card is how much they're going to spend on CapEx and the messaging and all that other stuff. That's hard to predict. And that's why the stock is kind of halfway in between here and more close to the bottom of a range. But over the next 34 days, wouldn't shock me at all if it wants to move high. So that's my view. And with Microsoft, oh, how I dip on these tangents, but I do. Um, Microsoft is setting up on the 200-day. And my guess is, 34 days from now, you'll be in this range. And it'll be, can they push it higher or lower? And if it goes lower, yeah, I'm in. Mercado Libre. After reading Constellation Brands conference call, I would not buy anything where the Hispanic consumer in the United States is the primary consumer. And that is absolutely no disrespect to those people. Okay. It's just, again, we're on an investing channel. We have to speak very rationally and frankly. And the trends I'm seeing from Hispanic people that are in America, they are tightening it up considerably across the board, legally and illegally. Put that in quotes, or however you want to interpret that. But anybody here, documented or undocumented, is another way to say it. They're across the board. You're seeing tightening of belts, and I swear I am driving through areas of town where you'd have like 50 cars on the road. Like it is like a ghost town, and I'm seeing for rent signs on apartment complexes that I haven't seen for rent signs on in years and years and years and years. That is on the ground what is happening. There is a real impact happening right now, and we are less than a year in to the Trump administration. And I don't know what's going to happen at the next midterms. I don't know what's going to happen, whatever. I don't think they're going to pass any big bill the rest of President Trump's term. But what's guaranteed is the immigration policy that is being carried out now will continue to get played out over the next 4 years. And so the trend that you're seeing in those industries will play out over the next 3 years. Guaranteed. Lamar for a REIT. Lamar, or is this Lennar, or uh advertising company? Ooh, I don't know. I don't know. Technically it looks fine. But I don't know anything about it fundamentally. Technically that looks fine. You've just confirmed new higher high, and that looks it makes me want to buy it. SMSN. Oh, Samsung. Oh, I mean, yeah, buy Samsung on a pullback. Samsung's foundry is looking good. Samsung's consumer electronic business will probably be under a little bit of pressure. Follow me on the social. I'll hit the Samsung booth. Samsung has a huge presence in booth, and I've made it to their keynote at CES. Consumer Electronics Show is next week in Las Vegas. And this will be the third or fourth year in a row that I've gone. I love this conference. Like, it's so fun, super fun. If you have a chance to go, like, for sure go. Vegas in general is fun, but this is like I don't do anything but work when I'm there. It's so much fun. And Samsung will be there. Memory business is on fire. Their foundry business is picking up orders. Samsung's looking fantastic. Yes, dividend growth. Avgro, Google, Gilead, EOG, which I think is like resources, mining, minerals, something in that range. Yeah, solid dividend growth for sure. I think we covered Microsoft. Stockton Ports games, yes. Stockton Ports, always a pleasure to go back to my hometown. Always humbling. I drove by a house that I grew up in on East Cleveland Street. And yeah, it's a humbling experience going back to Stockton. And I'm the man I am today. Not that that's saying much, but I'm the guy I am today because I grew up in Stockton and because of the experience I got to go through. And I got an arrogant, sometimes it comes through, people tell me about it. I have an arrogant confidence level of myself because that is how you have to carry yourself in Stockton. Otherwise, you'll get picked on. Otherwise, like it just happens in public schools, you probably even private schools, but especially the public schools I went to. If you didn't carry yourself like you were the SHIT, then you became a target. And so I walk around like I'm not. Covered calls. What I would say is I am definitely not qualified to speak on options, but I have been doing some covered calls. Um, but I'm a rookie in terms of its strategy. But I would say stay tuned. Give me another maybe year or two of of building up my skill level and my competence, I would say, and I will talk about it more, and it'll be a strategy that probably on the paid side I talk about, like actually implement a little bit more. It's a little tricky, options and a quote paid service. If you have a small, like a air quotes small service where maybe it's like 100 people or it's 50 people or something like that, that can work. What happens is if you get a big paid service and there's a lot of people following your recommendations, options trades, obviously, if there's not enough open interest, then all of a sudden you can blow out an options trade on a like, and so it's tricky. I've seen it not from my own thing, but when I was working at MarketWise, there were option services, and what they had to do is they actually had to really charge a lot for them and limit the number of people in it, because what would happen is if it went out to too wide of an audience, then the price of the option got blown out, or you had to only do like whatever S&P future minis where there's like all this open interest on that. So it's a little difficult for me to talk about options from a recommendation standpoint, but covered calls, I'm doing that all the time right now. And thank you, Robinhood. And I can see why Robinhood stock is up so much because they make that process super easy. But yeah, I'm doing a lot. Yeah, I love QXO. It's got a long ways to go, but I love it. Would I consider Chinese companies? Uh, ETFs is how I would play Chinese companies. Is probably how I would do it with a competent manager. I personally can't. I probably don't have a broker at this point that I can cheaply buy. I don't have like Interactive Brokers is probably the best example of one that if you want to buy international stocks, you should go with them. Uh, I am there's some stuff in China happening on the humanoid robot side that makes me very excited about Chinese companies. The challenge with Chinese companies is they always want to lower the price and squeeze margins to zero, and so it makes it tough from an investing standpoint. But I have nothing wrong with China. I have a huge amount of respect for the people there, especially what they accomplish. I even respect their government and how they want to operate things. Would I want to be a citizen operating under that environment? A businessman operating under that environment? Probably not. But as you know, an American, maybe leaning towards kind of libertarian type views, they have every right to do what they want, and they do great. Merck, yeah, Merck is a buy the dip. I mean, it's a buy the rip for sure. But yeah, I'm buying this one on. I'm hoping for that right there. Hoping for pullback south of, I would say, maybe 95. Retest of the 200-day. Yeah, I would buy that 100%. 100%. That chart looks fantastic. Toast. Oh my gosh, I love Toast. I don't know if you guys remember, but on my YouTube channel, I recommended Toast. I can't remember when it was, but I remember I recommended it and the people in the comment section destroyed me, and then the stock doubled. So I still have Toast. I bought it when I recommended it. I don't remember exactly when it was. I think it was in maybe 2024. Yeah, it was in the 20s. So I bought the stock in the 20s. Like I said, I got absolutely roasted and destroyed for it. Toast was the perfect example. I don't have their financials up here, and I won't pull them up, but uh, Toast was the perfect example of small cap that went. I bought it right at the turning point. So what you want to look for a lot of times is on these quarterly earnings. We're looking at Google here, so it's not the best example, but um, operating. Let's assume Google's operating income in 2024 was zero or negative. Okay, so put a negative number in front of this. So Google's losing money a year ago on a quarterly basis. And then a year later, they're growing their revenues a lot and they're controlling their expenses. And all of a sudden, maybe they're only losing a little bit of money. Maybe it's like a rounding error, or maybe it's zero or it's a positive number. That's when I like to buy these quote speculative companies, and that's where Toast was in 2024 when I bought it. They had just, especially software companies like this, and I know that it's like more than a software company, it's like hardware software. I like this. I wouldn't want to get it under 28. I wouldn't want to see it get under 28, but I like this company for long term. I like their product. I like what they do. I like their management. I like Toast a lot. Race, yeah, what is this? Ferrari or one of yeah, Ferrari. Um I don't know enough about the high-end vehicle market. That chart is ugly. It's rolled over. So I'd wait for some form of reversal here or support or a basing out. The chart's ugly, and you have a big gap that will fill at some point back on the upside. But that chart's a little ugly to me. I don't know enough about like I can't afford a Ferrari, so I don't know enough about it fundamentally. But it's cool. ACLS. Yeah, I've heard of this one. I've looked at this one. Um, this one's good. Yeah, this one looks fine. It's sitting right on the 200-day. So if you want to play it safe, you have to stop at like 74, 72, somewhere in that range. You get deep under that, then it's the 200 days gotten broken. Who knows? But that one looks fine to me. And also, look what you've broken out of. You were in this mega downtrend, and then you broke. Okay, so that's a very good sign. That one looks good. ANET. I love ANET. You poke around the industry. People aren't as bullish on ANET. I think they have a good executive over there. She's really cool. I think she's solid, and the orders can be lumpy. But they have a great client in Meta that's obviously spending a lot. They have other clients as well. Do I have a big weighting as Broadcom or where, like, in terms of semi stocks? Like if I have 10 semi stocks that I'm invested in, where's ANET? It's towards the bottom. Okay. So it's in the lower 10%. But chart looks fine and everything looks good. ETN, I like this company as well. It needs to hold this area technically. Would not want to see it get below 287. That would not be good. But I like what they're doing. The energy kind of you put Eaton in kind of like the electrical energy. They're supply constrained, but also how fast these data centers can get stood up. Everybody's trying to do it as fast as they can. It's tough. It's tough. It's really tough. A rule book. I might do a rule book at some point. I think I'm gonna write a book one day, but it won't be on the stock market. I have some very clear leadership and so to go back to like Stockton, California, obviously, like I had friends that are in jail, I had friends that died, like I could have been pulled in a lot of different directions, but so it takes a certain mindset. I might write like a mindset book. I don't know how well it sell. I don't know. It doesn't really matter. But I might do a rule book at some point. I have some rules. Don't buy 30 days before earnings. Don't buy a downtrend. That's why I wouldn't buy Adobe. That type of stuff for sure. Um, I can't. So the question is, would you provide a personal portfolio advisory service? So I down underneath my desk here is a book. I can't remember the technical term for it, but so to provide personal portfolio advice, particularly for a fee, you have to become registered investment advisor here in the United States. And I was studying to take that test. In fact, I believe I could. The hardest part of the test for me is the legal and compliance because that is not natural business. You have to understand the law, and you have to understand the law that was passed by Congress many decades ago as it relates to the financial services business. As I was going through this, I had a test date and everything. As I was going through this to become a registered investment advisor, I kept reading through the compliance section and I was like, this sucks because there is a blanket newsletter exemption that you can apply yourself to where you can speak broadly about the market, broadly about topics. I can't give you individual portfolio advice. I can't really give you portfolio advice, individual portfolio advice. I can't give you tax advice and those sorts of things. We can talk broadly about it, which is oftentimes why I frame things like, this is what I am doing. This is what what I do. If you frame everything like that, it's fine. If I were to go into the registered investment advisor route, we almost wouldn't be able to talk. And so that is why I didn't go down that route. I actually thought it would make my product and make my access to you guys even worse. So I'm more than comfortable becoming a registered investment advisor. I think I can become, I think if I'm not qualified, I certainly could become qualified. I could pass the test. I could do all that. It's the legal and compliance aspect of it, because these rules, most of the legal and compliance was written like 40, 50, 60 years ago, before the internet. And so the communication that we would be able to have would be actually be very limited. And so I didn't like that. I wouldn't even be able to do these live streams if I was a registered investment advisor under most circumstances. I certainly wouldn't be able to answer questions like this. And so I was like, no, I don't want to become a registered investment advisor. I want to be able to like have a big impact on people. And not that an RIA doesn't have a great impact. If you're an RIA, or if you're a young person listening, it's a great path in another life. Maybe that's the path I go down, but I can't legally give you portfolio advice, is how I would say. At least right now. Maybe later in life, when I don't want to do content as much and I don't want to freely talk and I want to only deal with like 100 people, then yeah, I become an RA and I deal with 100 people and their portfolios. But right now I have too much fun talking about the markets and making predictions that don't come true or whatever. That's what I like to do. Tech chip companies will hit this year the most, getting a big sell signal that tech has always downside by the charts. I don't know, man. Maybe. I've been hearing that, we're going to get this. I mean, yeah, we suffered through like a 34, 40% drawdown in the chart. There's nothing in that chart right now that is telling me that a big sell-off is coming. And until it does, I just let the price tell me what's happening. The momentum, everything is still higher. Suppliers like Micron are signaling higher sales. How the market interprets that, I don't know. How tariffs and whatever President Trump decides to do and global events decides to impact the stocks, I don't know. But I think if you had the attitude that tech was crappy, then you might have made more money if you just let the chart do the work for you. Would you not say that energy services usually runs next after materials? I don't know. So how I'd answer that question. I'm not sure. I'm an animal. Thank you, Aria, for coming on. 4 hours strong. Guys, we could go longer. Like if we needed to make this 18, 15, 20 hours, we could. Is Intel really buying Samba Nova? Yes, it is. It's my understanding. Samba Nova was like a startup owned by or funded by Lip-Bu Tan, the CEO. So yeah, he's coming in there and cleaning up some of his venture capital. But right now in Lip-Bu Tan, we trust, guys. I can't believe I'm saying I'm trusting an Intel CEO, but I trust Lip-Bu Tan, guys. Maybe it's because I went all in at 20 and we're at 36. But you nail Foundry, and this is $100 stock. Clean. I'm up 500% on Avgo, and it's currently 7%. Do you think I should trim? Let your winners run, is what I would say. Followed Colin into Intel and did well this time. Hey, well, that's great. That's great. We were just talking about Intel. Yeah, the 200-day moving average has gone parabolic. It's not without its, like we zoom this chart out. Like it's not surprising that the stock is meeting resistance here, because you can see the continuation of the downtrend would just take you where you're at right here. So, it's not all sunshine and roses, but there's clearly demand for the stock down at 20. And as long as the foundry business is like on track, again, this is speculative. Intel is speculative as hell. It could get wiped out for sure, but I think the higher probability is it goes to like 60, 70, 100 for sure. The worst drop report in 2025 or years could be the slowdown in years is my concern. I mean, maybe the worst job report in years. That's possible, but there's offsetting factors to jobs as well. When I was buying a lot of stocks in 2011, 2012, the job numbers was bad, but interest rates were zero. So you're fighting uphill a little bit when you're cheap, easy money and government spending. Um, to have these big drawdowns, pandemic, tariffs, great financial crisis, excessive leverage, that type of stuff, certainly can happen, but it's tough. Silver, oh yeah, it peaks. Uh, I mean, I'd be shocked if silver doesn't peak in the next soon. It might have already peaked. This is not normal. This is not normal, clearly. So yeah, I'm not. Yeah. Lots of people leverage the paper silver. I mean, yeah, that's why you have this move, because it's not only leverage to the long side, it's leverage to the short side. So you have this massive short covering. And so this type of move, vertical move, is not normal. Now, if you're a company and all of a sudden, like, you release your product or you got a miracle drug or whatever, of course, a stock with a fundamentals attached to it can go parabolic like this. But a metal to do this, I mean, you see the last time it happened from 2010, you went from 18 to 50 basically on silver, and then it went from 50 all the way down to like 15, and that's where I started buying quite a bit of it. Was in this range, and even a little bit before that. So yeah, when silver makes this move, it's guaranteed you're going to have probably an equal or greater move lower, for sure. I don't trust Chinese companies and avoid them by play. I hear you. I hear you. I hear you. If there's money to be made, I'm down, but it's difficult. Conagra. It's rolled over, it's on support. That's an ugly, ugly, ugly chart. You need to hold the level it's at. I would not want to see it get much lower, like the 15-ish level. You don't want to get below, like, even, yeah, you don't want to get below 15 on this one, because then it's this consolidation. Let me show this to you, volume profile. My guess is the volume profile will confirm it. So you slap on this volume profile, it shows you where everybody's bought the stock. Where did everybody buy the stock on Conagra? They bought it down here at 10. Okay. That's why you don't want it to get below 15, because between 15 and 10, nobody bought the shares. And by nobody, I'm just meaning from a volume perspective. I mean, there's like nobody accumulated the shares here. So it's just showing you, like, that's why you don't want to break these levels. And this is how and where you set your stop loss levels. Like, you can go on like feel and gut and all that stuff. And after you look at these charts enough, it just stands out like you don't even need the fixed range volume. I didn't need the fixed range volume profile to tell me that if you broke 16, you came down to this clusters, because that's where all the candles are. So clearly there's volume down there. And there's no volume here. So that's what's happening here, is you don't want to get below 15. If you find 15 and you find some footing, you're going to meet resistance. This is what's difficult about these charts is, okay, you buy Conagra and it holds 15. Okay. So you buy it here, it holds 15, doesn't break your stop. The challenge is now back on the way up, you have all this consolidation that you got to break through here. There's all these people that bought Conagra at like 30, 40 bucks. Okay. Not quite 40, but like 30 bucks. And they're sitting on 50% drawdown. So when they get a chance to get out for even money, minus dividends, they'll do it. And so you have selling pressure back into this level. That's assuming no fundamental change, management change, business plan, all that type of stuff. It's all things being equal, just price, which price has a big impact on especially companies this large. You don't want to get below 15, but even then, on the way back up through 25 is going to be a long, long, tough one. RTX, rocket stock, RTX. I'm not into the, oh my God. I mean, that's gone parabolic. So yeah, that looks fantastic. Whatever they're doing is fantastic. Yeah, this is a good one. RTX. I wish I was in this one. I'll tell you that. You waiting for a little pullback on that one? Pullback, stop loss, winner's run. That looks fantastic. Oh, aerospace and defense. Yeah, I mean, it looks amazing. Amazing. That chart's amazing. Rocket Lab, I mean, Rocket Lab is like crossed over into kind of that meme stuff. So it's tough. It's tough. These stocks are tough when they cross up. Now, if you bought Rocket Lab at like 5 and it's crossed over into meme status, that's fantastic. It's amazing. It's at the top of the range. It's just confirmed a new higher high. That's fantastic. You can buy the dip. That's how I see that one. Thoughts on Palantir short? Whew. You are a absolute stud if you can short a stock like this. You're a braver man than me. You can short these. I've got a purple line here, this purple top trend line. You can short them when you get there. Not something that I do personally. You did confirm a lower high here, so that's not great, at least on a weekly chart, but you're still locked in a massive uptrend on this one. And the retail crowd is they're in this one. So wouldn't surprise me if it goes lower, but man, if you can short a stock like that, man, that is fantastic. Thank you. Chris, he says he's an early equity empire registration holder here. Thank you. Super value. Thoughts on CRISPR? Yeah, so CRISPR, I'll tell you, Chris, I don't know enough about the technology, number one. I don't know enough about how it's progressing. I remember looking at CRISPR when it kind of went parabolic here and looking at it, and it was like, okay, that makes sense. Gene editing and therapies and all that other stuff makes sense to me. My IQ level is not high enough to speak on this one from a fundamental perspective, but what I do see here is a very strong base of consolidation for price between 40 and 75. In fact, you're right in the middle of that. If I were to buy these shares, I would not want them to get meaningfully below this low here at 28, maybe even a little higher at 33. Wouldn't want to see it get meaningfully below that. And you're waiting for a breakout above here. A break above here shows me that CRISPR is onto something, whether it's revenue or product or adoption of the technology more broadly, those types of things. A break above 85 would show me that they're getting very close there. You've had some false breakouts in the past. And so what you can do is when you do get these breakouts and then you get the pullback, when you buy it on that breakout, the stop can be just right underneath that because it 100%, not 100% of the time, most of the time, technically, if you have a breakout, two things are going to happen. And it's obvious when I say this, but these are the two things that happen, and this is how you set up these trades. So you have an initial green candle higher, but it's almost always followed with a back test of the previous highs or the previous trend. That's what you did here. So you can buy CRISPR, this is revisionist history, at 75. If I bought it at 75, I'd want to stop, at 70, 69, somewhere in that range. Don't want to get it meaningfully below that because what happens is if this is a false breakout, you almost always run back down to the bottom. And that's what it did back here. It had a breakout, back test, ran all the way down. So I risk losing a little bit of money, couple bucks, whatever, per share. No big deal. Because here's the upside is one day, if this company is legit and their product gets adoption, that's going to be the launching point. And you are literally going to go from like 70 to like 150 on this one in probably a matter of weeks. Okay. You've seen it with a great example is Google from a mega cap perspective. Okay. Previous highs, blast off. Actually, the previous highs, and I have this yellow line on here to is basically an example of this. And we're on a weekly view. You can change this to a daily view and get a little bit better picture of it. But you finally broke the previous highs on Google. It did a back test for a day, like probably an hour, and then you gapped and you ran. And you literally went from 205 to 300 on this one in that is August to November. So that is what, like 4 months. So you added $100 in 4 months. That's the power of the breakout. There was another one that we sent to subscribers. This was not kind of an official one, but I kind of pointed it out like kind of as a bonus, like, hey, if you're interested in this, you can do it. Johnson and Johnson traded sideways forever, and then the breakout was here. The one I'm watching very closely now is Disney. It's not as technically perfect as the other ones, but look at Disney, guys, and say what you want on, like, do I want my kids watching a Disney movie? Probably not. But not all of them. But here's your resistance level. It's not as clean as like Johnson and Johnson was, but you've got resistance here. And look, it's not great, but you're making a series of higher highs, higher lows here. Disney looks like to me it wants to break out, wants to break above 120 and then run. So that's what I'm looking for there. So if I bought Disney, right, I would buy it at like call it 120. I'd have a stop at like 118. I'd risk $1 on this with the idea that finally you're going to break out. And if it doesn't break out, whatever. This one's nice because it's converging. This blue line is a 200-day moving average. So you're going to creep up here to this level where you buy it. And then you're going to have support at the 200. If I were to buy this one, I would actually want my support underneath the 200. So I'd actually risk a little more, probably like a 10-15% drop on this one, with the idea that maybe it's not like a parabolic move with Disney. That would make sense that you don't get this parabolic move. But over the course of a period of time, you just do this like chop higher. That's what that one looks like to me. So that's kind of a trade setup. If you're like looking for setups, that's something that I look for. Thank you for being there's so many people that are subscribed in the chat. People are going to think I like pay you guys to be here. I appreciate it. Thank you very much. And like I said, I really appreciate, I say these a lot on the private videos or whatever. Appreciate you guys being subscribers. I'm certainly not perfect and don't have a perfect track record. But I wake up every day trying for that. And believe me, it pains me deeply when things don't go well. But like, look, when things go well, it's fantastic. Oracle, I mean, I still really like this stock. We haven't gotten back into it. I'm not super bullish the data center sector, but Oracle's got a database product as well that's pretty strong. And if you follow the progress of Abilene, Texas, which is one of their Stargate locations, and then they also have one in the Middle East, these guys can stand up data centers, and that's the name of the game. They are tied to OpenAI, so I'm kind of waiting for that. You can see here on my chart, I have this line. It is at a spot. If you wanted to go with Oracle, you could. I'd have a stop underneath probably the 200-day. So you're still risking like 50 to the downside on this one. I don't think we parabolically move back to 300 on this one. I just think most of Wall Street has not Twitter. Like if you go to Twitter, like people think IREN is going to be like $1 trillion company. And it's just I mean, it's cute. They thought that about Hims and Hers and Duolingo, and they learned their lesson. Wall Street is convinced Oracle and Nebulis and IREN and these companies are going to go bankrupt. Well, big air quotes here, and I don't believe it. The smart money thinks that these stocks are worthless. I don't think they're. I think they're somewhere in between. But the easy money is over with these stocks. I think it's a much longer trudge higher on these stocks. They've already signed the contracts. It costs a lot of money to stand it's like building an apartment complex, right? Like building an apartment complex is probably a great business over 10 years, but you've got to sink a ton of capital into it. And now you got to collect rent for 10 years and replace air conditioners and do all that stuff. The data center business is the same thing. Same thing. What's your take on banks? I mean, I sold JP Morgan like over here. And I don't normally take profits on these big mega blue chips, but like I don't know. And I feel like maybe my read is not accurate. At least Wall Street's not agreeing from a price perspective, but compression of rates and compression of spread, a net interest margin spread, where banks borrow at one and they lend out at another. I understand that loan demand will increase as interest rates come down. So volume will overtake net interest income. But I don't know. Do I really like, first of all, I love JP Morgan. If I were to own a bank stock, this would be it. And for the longest time I owned it. I just decided to take profits on JPM and rotate into Broadcom in particular and Amazon. I just see higher upside there. But on a pullback, yeah, I'd buy JPM. But I don't know. To me, the bank trade, it makes a little sense. This also doesn't signal recession. I mean, this signals like, like, damn, they're going to do really good. Twilio, I don't know as much about Twilio. TWLO. Chart wise looks amazing. This is like, take note of, and I know Twilio is not like software, but take note of what's happening with these names. That is a beautiful chart right there on Twilio. That is beautiful. Okay. Now it's at the top. Would I buy it right this second? No, but that's a buy the dip for sure. Brookfield Corp. Yeah, I think they do like investments in different type of infrastructure, I think, or investment management. I mean, that chart looks amazing. That is a new higher high, so a dip on that one is bought for sure. I'm short. Yeah, I mean, if you've got a short trade on, you're a smarter guy than me. And I've had people tell me like, Colin, your instincts on shorts are pretty strong. I just don't put the trades on. To me, like a short makes more sense when there's a leadership problem. When there's a leadership problem, you can short. Like Target's a great example. Like Target fucking sucks. I mean, their leadership is terrible. So no wonder the stock, it looks bad. Intel for the longest time had terrible leadership. So of course the stock looks terrible. Do I play options? Not enough to speak confidently on it. Like I've done options trades this year, and like my success rate is really, really high. But I don't know it nearly enough to speak confidently on it. I can tell you the whole supply chain of Broadcom and Nvidia, so I can speak confidently on that. And I understand from like a third or fourth grade level how their chips work. I'm not a computer engineer. I wouldn't be able to tape out a semiconductor, but like I've done months of research on that, so I can speak confidently about it. Options are not exactly my thing. Disney, yeah. I mean, yeah, Disney, like, look, this is why I have the chart make some decisions for me, because like I said, would I want my kids watching a lot of Disney movies? Not the ones that they're coming out with now. But we don't even go to Disneyland. They're not even interested in it. But yeah, this chart looks like to me it's ready to break out. CoreWeave. Um, CoreWeave. Yeah, you better have a stop loss on CoreWeave. I'd have a stop loss right where the lows are. So right here at 64. You don't want to get below that because then you're retesting the IPO price down in the 40s. This chart is ugly. High, lower high, lower high. Low, lower low. Confirmed. This is the start of a downtrend. This is what I'm seeing in data center stocks is right there. That's not good. Okay. And I actually think CoreWeave is the precursor of it. Okay. Because the IRENs, you stretch the chart out and you're like, oh, it's fine. Not if you look at it right there. That's not a pretty candle. And you're way overextended. These businesses will be around, but they're slow compounders. People have completely overestimated these companies' ability to generate revenue and profit margin. That's why the software layer is so exciting, right? Because a Manus can start up and get to $800 million or $100 million in ARR in 8 months. And if they run things super lean, they probably are profitable on that 100 million. Whereas IREN is not going to be profitable until Microsoft potentially renews a contract with them. What are the thoughts on Boeing? First of all, thank you for being a subscriber. About a month. Appreciate it. Thank you. A lot of fun things and more things coming for and I would say with subscribe, like I get a lot of people ask me like, hey Colin, can I do a month-to-month subscription? Can I have a quarterly subscription? And I would just say broadly, the best thing to do with investing is give yourself at least a year look back. And look, if you change your mind or those types of things, that's fine. But I would say give yourself a year or 2 years looking back on your investments. If you're a trader and you're looking super rapid, then yeah, you're compression. But I would say with my stock picks, man, you've got to let these things This is why I sell a yearly service, because I want people to, like, 1 month it might kind of suck, 2 months might kind of suck, but like over the course of the year, things should be pretty good. Boeing is fantastic. Here was my chart on Boeing. We just completed a breakout and a back test on Boeing. This is one company that I'm so excited about. Boeing was in a well-defined downtrend. We recommended it as a subscriber at some point. I can't remember. I think I re-recommended it, or I kind of adjusted the buy range. Because what happened was you broke out of the downtrend. You were in this downtrend. Let's change this to like an orange line. This is the downtrend. It's ugly, but it was wedging. It was being confirmed by high series of lows. That's good. It often signals a breakout is coming. You got it with Boeing. You broke out. It's fantastic. I was expecting a pullback to trend. That's exactly what you got. And now you've bounced off that area. And it doesn't mean it's back to the moon with Boeing, but yeah, to me, like, reasonably get back to 360. Knock on wood, all the safety stuff. Gosh, I hope the safety stuff with Boeing is good. Obviously, we all have loved ones and ourselves fly. Uh, you know, please God, Boeing makes safe airplanes. If they make safe airplanes, 360 is coming. They have half the airplanes sitting in inventory ready to go. So they have a great, 4 hours. We probably should wrap it up. We've looked at Nike. I love Nike. I bought Nike in 1997. My advice is don't buy Nike stock. Go buy a Vomero Premium. And I'm not joking about this. These shoes are incredible. If you're comfortable spending $300 on a pair of shoes, I can't tell you how good these shoes are. If you run, these are incredible. I haven't run that much, but my son wanted to race me one day, and I happen to have these on. And I was like, oh my God. I used to run a little bit more, but now I can't. My joints in my back, I wouldn't be able to get up in the morning. So I try to do like walking, healthy eating, stuff like that. These shoes are incredible, guys. And to me, this is a fundamental sign that Nike is back. They don't have to release some Jordans or some Dunks or some stale style. They come out with a brand new pair of shoes. That these shoes are incredibly comfortable, like unbelievably abnormally comfortable. They also make you about 2 inches taller. So when you're like 5'10", 5'11", like me, another 2 inches, now I'm looking eye to eye to guys 6 feet. I feel good about myself. So I love these shoes, and I can't wait to get another pair. So as weird as that sounds, I would have Oracle and other AI plays. It's like 1997 or 07. It's 1:30 a.m. and the bar is getting ready to close. I don't think we'll go bankrupt, or we'll see Cisco in 2000. We'll be around to take that for a while to ROI. That is possible. Possible. Yeah, we could be in 1997 or 07, 1999 or 07. 07 was less about tech than it was about maybe over leverage in real estate. What I will say is even post 1999 was a great time to buy tech. Post 07 was a great time to buy tech. So even if the music stops and we get a sell-off, that's fine. It actually opens up kind of the golden age. In fact, the iPhone was released in 07. So it triggered one of the greatest investment theses of all time. What I am seeing at the application layer and at the company level is that the demand for AI is off the charts. And it's not for AI slop. It's not for stuff like that. It is legit demand. That's what I'm seeing. And it is being supported by companies like Google and Meta and Microsoft. I mean, the core weaves, the thing is like, we can't lump the core weaves into tech. Core weave is a derivative of all of that. Even maybe like a Palantir. His Palantir had its run and it'll pull back and trade a little lower. For sure, that's possible. That's absolutely possible. But the durable business models out there, these charts look fine. These charts look fine. The financials look fine. The fundamentals look fine. Um, we'll see what happens. I appreciate the $20. And if we do have a mega bankrupt blackout of 07, please come to California and we'll go out to dinner, and I will gladly reward you with a $20 more than a $20 steak. $20 steak probably not gonna taste good. We'll go for 200. I use my crowd profits to buy a house here in SoCal. Well, I bet you got a lot of crowd profits if you bought a house in SoFi. Because houses in Southern California are absolutely no joke. Folks, my battery on my second computer that I'm looking at here is probably going to go out. I appreciate it. Didn't expect to go 4 hours and 14 minutes, but all the questions and all the support you guys have given me, not just over the past year, but the past several years, I greatly appreciate it. And we will join you again. It's Thursday, so tomorrow for the Fang Stock Recap Show. Make sure you join us over on the main channel. I'll be back. We'll discuss tech. It'll be shortened trading week and all that type of stuff. So yeah, we'll stretch it out. And like it happens to always be like a 30 or 40-minute show. There's a lot to talk about with the Manus acquisition that Meta pulled off, with the Grok acquisition as well. We'll talk about a lot of this stuff. I don't think it's a coincidence that these very important acquisitions fell at the end of 2025, because I think it kicks us into 2026, where companies aren't going to be able to do nothing with gold. And companies like Adobe and Trade Desk and Chipotle and the Nikes and the Starbucks and the Targets and the Novos and the PayPals and these companies that aren't at the top of the world, they're going to need technology and they're going to need AI. And when I did the Costco video for the paid subscribers, Costco gave an extraordinary example of how they're using AI in their business. And they're about to apply that to their best-selling business, which is gasoline. Not the membership's their best-selling business, but probably one of their biggest businesses is gasoline over at Costco. And they're about to layer AI onto that. Here's what I'll tell you about AI is the use cases are not going to go away. Any workload that transfers to AI is not going to transfer back to a human. Once you get AI to do the thing for you, you do not go back. I will be in Las Vegas, Nevada next week, January 6th through the 9th. I'll have to figure out how I do that Friday show. Maybe we'll do it live from the Tesla on the way back. I don't really know. We'll see. That might have to be a Saturday show. Or maybe I'll hang around in Vegas long enough to do it there. I don't know. We'll see. But I'll be in Las Vegas, Nevada next week, 6th through the 9th. If you're in Las Vegas, if you're at the Consumer Electronics Show, get a hold of me. And if not, stay tuned for some content, particularly on the paid side. I will be posting a lot of things there because it just is easier to package there. People say, oh, you posted all on the paid side. Well, it's just easier to publish over there. I don't have to wrap it up. Like if you do a YouTube video or you do a Substack, it has to have a level of quality. Not that I'm trying not to do quality, but you can have a level of volume to a paid subscriber. And so that's why I do a lot of stuff over there, and they'll get a lot of content, but I'll throw some stuff on the paid side or the public side as well. And either way, I appreciate all of you. Happy New Year. I hope this year is filled with joy and happiness and all types of things. And that's right. I'll hold you to the promises next year. That's right. If we have a crash and burn year, Solja 707 1986, I will personally fly you to California. I've got a million miles on a credit card for American Airlines, and I don't fly anywhere. So I can probably get you out here on miles that I have. I'll fly you out to California. We'll meet in San Francisco because that's probably the airport you'll fly into, or San Jose or Sacramento. I will pick you up. We will go to one of the finest restaurants in the area, your choice of cuisine, and we'll do it. I'll probably set myself up that we'll have a major crash and we'll be doing that. We'll film the whole thing and we'll talk about it. Thank you very much. I'm glad you couldn't get bored, but my voice, I probably should get some water and save up for Friday. I'll see you guys all tomorrow. Thanks for tuning in, as always, with the support and everything. Let's do it. Jack, hit me up. I'll get you. I got a brand new Tesla. We'll throw you in it and we'll go to Vegas. Let's do it. Thanks for tuning in, guys. We'll see you again soon. Thanks for being a subscriber. Bye for now.